Momentum is a powerful thing. It's hard to fight against that trend.
The way that both the stock market and the bond market have acted is logical.
One thing that we can say is that the election result and what's coming out from there is just simply reinforcing a narrative that was already in play.
If you do actually get a shift back to rate hikes, it could really go against that bullish sentiment right now.
Sentiment, the news flow, it was already very, very strong. At some point, you think there's got to be a breather.
This is Bloomberg Surveillance with Jonathan Berro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with a sneak peek at a price action, which looks like this. Equity futures on the S&P 500 slightly firmer by not even 0.1%. Coming into Thursday with this equity rally through this week, losing just a little bit of steam. That's the equity market. Here's the bond market. Price action yesterday, really interesting. CPI comes out, 2 years anchored yields drop. The 10-year yields continue to creep higher. The 10-year this morning, 445.51 on 10s. The 30-year, 462. The sneak peek of the day ahead, the next 24 hours, looks a little something like this. 8:30 Eastern Time, jobless claims, and then this afternoon, Chairman Powell speaks at 3 p.m. Eastern. Before we get there, the main event in the last 24 hours, Anne-Marie, a trifecta in Washington.
The Republicans were poised to have this trifecta, and now they've gotten it over the finish line. We still don't know yet, though, Jonathan, how big that margin is going to be, or rather, we should say how slim that margin is going to be. Historically, this might be one of the slimmest controls of Congress Speaker Johnson is going to have to deal with. With that all being said, he already has problems on his plate. He needs to fill 3 of those seats. Elise Stefanik, the representative from New York, is being plucked from the incoming Trump administration to go represent them at the United Nations. Then you have Congressman Waltz of Florida. He's going to be Trump's national security advisor. And then late last night, Matt Gaetz, the Florida congressman, resigned. Now, many will tell you potentially on the Republican side he resigned because he's being tapped for attorney general. No. Punchbowl News reporting that a House Ethics Committee was going to come out with a report, and once you resign, that report dies.
Well, it's the thinness of it that I think this market needs to be paying attention to, because we've gotten so excited about deregulation, about tax cuts. A tax fight is about to be underway. If you have such a slim majority, can you deliver on all the promises that this market believes it's going to have and is trading near all-time highs?
Got to work out the sequencing as well. What's the priority going to be? Is it going to be the push for tariffs? Will it be the push for tax cuts? Equity futures right now on the S&P positive by almost 0.1%. Check out the FX market. This is one to watch. Euro dollar coming very close to a 104 handle, 105.09. We're negative 0.5%. More dollar strength, more euro weakness. Coming up this hour, we'll catch up with Keith Lerner of Truist, expecting the bull market to power ahead. We'll speak to Rob Casey of Signum Global Advisors as the Republicans secure the trifecta. And Elsa Lignose of RBC saying US dollar strength is here to stay. We begin this hour with stocks on hold ahead of fresh economic data. Traders awaiting US PPI and jobless claims at 8:30 Eastern Time. Keith Lerner of Truist writing markets are pricing in most of the positives today, though the backdrop is complex. Still, the weight of the evidence in our work indicates the bull market still has some longevity left. Keith joins us now for more. Keith, welcome to the program. Let's start right there. Why do you believe this bull market has legs?
Yeah, well, first, great to be with you all. Well, I think this bull market has proven time and time again that it deserves the benefit of the doubt. And if you take a step back, we still lean bullish. I also think the range of outcomes as we move into next year is going to be wider for all the reasons you all discussed this morning. But again, when we look back historically, the bull market's up about a little bit less than 70%. That's still below average on a 3-year basis. We're around the average type of return. The earning trends for the market are still moving higher, so I think that's positive. The Fed just cut rates. Global central banks are still easing as well. Valuations are rich. Sentiment's a little bit stretched, but we all know on a short-term basis, it's really hard to make a valuation call by itself. And I do think as we move into next year, you talked about deregulation, lower taxes likely, and that's going to be offset by the unknowns on the tariff side. So all in all, we still, like I said, lean bullish.
We know the risk factors. Tariff is part of that. We've got the trifecta, Keith, but very small margins in the House. Have you taken a view on what the sequencing will be for policy?
Yeah, well, it's I think no one knows for sure, but we do know that tariffs can be done unilaterally, or at least to a certain extent. So I suspect you're going to see that up front. It's interesting when you go back to 2017, the corporate tax rates didn't actually get passed until the end of the year. It was almost good that it was out there lingering that, hey, this is coming, so let the market continue to move up. So I think tariffs probably first, and then you'll probably see more discussion around the tax cuts. But also, part of the reason why the bond market isn't responding even more vigorously is that any type of tax cuts is going to be a lot different, or a lot less than what we saw back then.
Keith, when it comes to the tariffs, though, do you have a base case of whether or not we're going to see 10% ring around the United States, 60% on Chinese imports, or do you think it's going to be a negotiating tactic?
Yeah, I think we're all guessing, right? I mean, from the history, we suggest that it's going to be more negotiation. And I think there's also going to be a difference when we talk about tariffs. A lot of this is kind of lumped together. There has to be a distinction between what happens with China and then what happens with the rest of the globe. I mean, obviously, President Trump sees China as a national security risk, and therefore implementation there is likely going to be, quicker and faster. The rest of the globe, it's probably will be that will be part two, I think. But I mean, all in all, though, we also have to be careful. If we go to 60% on tariffs there, it's a sales tax. So on the consumer side, we're going to see that move up. And how much do we want? How much does President Trump want to see prices moving up right away? So I think part of it is going to be negotiation. We don't expect it's going to go to the 60%, but I certainly do expect some tariffs to go into effect and China to be number one on that list.
Keith, we got a number of nominations yesterday, and many are saying, especially many lawmakers in the Senate that would have to confirm these individuals, are shocked and think some of them are unconventional. Do you think that could degrade Trump's priorities and potentially be market negative?
Well, I think as we have continued political uncertainty, it just, again, to my point earlier, leaning bullish, but the policy outcomes is wider. I just think we're going to have to deal with this kind of on a day-to-day basis. There's some good and bad aspects, right? Maybe, with such close margins, transformational change will be somewhat more challenging. But if he doesn't get something done through Congress, then he may look at what he can do unilaterally. And one of those things is things on terrorist, immigration, things of that nature. And so I just think we're going to have a lot more to write about next year and a lot more twists and turns. But again, when I think about the market perspective, I still have to go back to, okay, is the economy likely to go into recession next year? Our answer is no, right? Because we're extending those tax cuts. There might be some more policy uncertainty, but I don't think Trump, who, partly campaigned on a better economy, wants to see the economy go into recession the first year. So as a starting point, that's a positive for the market because that should then support corporate profits into next year, which are expected to grow, double digits into next year.
When it comes to corporate profits, though, Keith, if we have a scenario where big global American companies are abroad and they're basically confronting a scenario where they need to move back to the U.S. or face higher tariffs, is that not going to be an issue with margins? Are they not going to have to do more profit sharing with American workers? Are we about to see a squeeze on the horizon?
And I think there will be to a certain extent. I think the question becomes what industries, but on the margin, yes. But there's also on the other side of that, if you do have somewhat lower taxes, there's going to be some offsets. And there's also, going back to margins, another part of the margin story is what interest rates are. We know corporations, a lot of them are locked in at lower rates. We still think the Fed actually still moves lower next year, even if they do it at a slower pace. But so yes, what we're talking about this morning is just this a huge range of cross currents. I do have confidence, though, that once we know the rules of the game, corporations will adjust. If you think about the last 5 years, we had a once-in-a-generation pandemic. We saw the highest inflation since the 70s. And what have we seen corporations do? They've had record corporate profits year after year. So I think initially they will be hit. Some industries certainly will get hit more than others. But eventually corporations, like they always do, they will adjust.
Keith, just given what you're saying and all the different cross currents, how difficult is it to be a medium-term investor right now? How difficult is it to build a portfolio for the next 4 years when we just don't know how things will shape up?
The future is always uncertain. And I would say as you extend your time horizon, even from 4 years to 10 years, the probability of success is actually improves when you look at just regardless who's in the White House. So listen, I know where there's so much focus, especially after the election, on just the election, on the policy out of Washington. But we also have to remember that institutions and corporations, are a big driver of the overall economy. So, from our standpoint, we are still positive on equities on a relative basis for the next 5 years, for the next 10 years, even though I think as we move into next year, this really serene environment that we've seen this year, like the market up 25%, pretty low volatility is likely going to shift. I think the underlying trend is still positive, not only for the U.S. economy, but for U.S. corporate profitability as well. And the one thing we haven't talked about is also, technology, AI. An interesting note that I saw out of the Palantir earnings report, they talked about how that one of the major insurance companies, as far as for underwriting, they cut their process, they automated it from like 2 weeks to 3 days. And then talking about the government side, they talked about disclosures that the government has to give to their to foreign governments around just intelligence sharing, that they cut that from 3 days to 3 hours. So there's also a productivity side of things that I don't think should get lost because of what's happening in Washington.
That stock's been on fire. Absolutely ripping over the last few weeks, that's for sure. Keith, I want your thoughts on NVIDIA. Reports a week today, I think. How NVIDIA dependent do you think this equity market still is, given the big changes we've seen post-election?
Yeah. Well, I think what's going to happen as we kind of move past a couple of weeks past the election, we're going to get back in focus. And I think that's a very important report because technology is over 30% of the market. Semiconductors have been making relative lows. It's really, it's NVIDIA, Broadcom, and then everyone else. And there's huge divergence within tech. Software is doing better, but I still think with such a big allocation and the Mag 7 being such a big part of the market, that report next week is really going to be important. And also to our thoughts that there's more to go in this rally. If that were to, to not meet expectations, which we think they will, that could be obviously a risk for the year-end rally that we're expecting.
Hey, Keith, good to catch up. Thank you, sir. Keith Lerner there of Truist. Keith mentioned Palantir. That stock is up by 46.58% over just 7 sessions. With an update on stories elsewhere, let's get to your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. President-elect Donald Trump continues to fill out his cabinet. Former Congressman Matt Gaetz has been tapped as Attorney General designate, while former Congresswoman and former Democrat Tulsi Gabbard is the pick for Director of National Intelligence. And Trump confirmed Senator Marco Rubio is his pick for Secretary of State. But Treasury Secretary is still unknown. The Wall Street Journal reporting Cantor Fitzgerald CEO and transition co-chair Howard Lutnick is making a late play for that role. Meanwhile, the sweep is complete. Republicans have maintained their majority in the U.S. House, giving them unified control of the government. The Republican win strengthens their hand to enact immigration controls, reduce regulations, and extend tax cuts. The trifecta control sharply diminishes any hope for Democrats to curtail Trump's sway over next year's big fights over trillions of dollars in expiring tax provisions. And Manhattan apartment rents climbed in October to the highest level in 3 months. No relief. The median rent in the borough rose to just under $4,300. That's a 2.4% increase from a year ago. Analysts say that would-be homebuyers put off by high rates are keeping the rental market active with high demand. New lease signings in Manhattan surged about 24% in October from a year earlier. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes' time. Up next on the program, the Republican trifecta.
It could be, I believe it will be, the most consequential Congress in the modern era, most consequential administration in the modern era, because, frankly, we have to fix almost every area of public policy.
That conversation up next, live from New York City this morning. Good morning. Check this out. Euro dollar, seconds ago, 104 handle. Lower the session, 104.97. Right now, 105.04. The target from Jordan Rochester over at Mizuho, 103 year end, 101 by the time we get into the next quarter. I don't know if we make it to the end of the year before we get to parity. 105 on euro dollar, Danny. This is quite a decline, a 5-day streak of weakness for the euro.
It could get even worse than all those estimates. George Saravalis at Deutsche Bank says that if we see the full force of Trump policies, we'll see below parity. We'll see 95. Just a very basic Trump tariffs, maybe a slight tit for tat. That will be parity. That is his base case.
Elsa Lignose of RBC joining the program just a little bit later. Under surveillance this morning, the Republican trifecta.
The theme that you'll hear over and over from all of our members across the conference is that we are unified and energized and ready to go. Serious times call for serious leadership. It's going to be a policy agenda-driven administration and a Congress. And you've heard us say many times that it could be, I believe it will be, the most consequential Congress in the modern era, most consequential administration in the modern era, because frankly, we have to fix almost every area of public policy.
So here's the latest. A red sweep taking over Washington as Republicans secure a House majority, holding at least 218 seats with a razor-thin margin. President-elect Donald Trump's priorities coming into sharper focus. Rob Casey of Signum Global Advisors saying, we believe President-elect Trump and trade advisor Robert Lighthizer are committed to implementing an aggressive tariff agenda, likely beginning with Europe and ending with China. Rob joins us now for more. Rob, good morning.
Hey, John.
The sequence, it's a big focus for financial market participants worldwide. You think that it's going to start with trade and it will start with Europe. Why?
Yeah, well, first and foremost, it's not to say that we don't think that they're not going to wait on China for very long. But we do think that Europe is the day one priority, mostly, speaking very bluntly, because we don't think Trump likes Europe a whole lot. And essentially, we're dealing with what is not a net neutral landscape, but a net negative landscape. CBAM, deforestation, steel, Airbus, there are all of these tripwires that, the pro-EU presidency of Joe Biden was not able to deal with, was not able to handle. We think Trump comes into office essentially with all of those tripwires laid out, not really looking to avoid them.
Ron DeSantis, the governor of Florida, is in Italy right now on a trade mission. Who do you think Trump views as someone he could work with in Europe?
Well, I think it's Orban first, and then when Trump realized that Orban actually doesn't have a whole lot of power in the EU, it will be Meloni second.
So when it comes to the tariffs, and if you think they're going to be enacted first, personnel's policy, as you know, in Washington, D.C., where does he put Lighthizer?
We think Lighthizer could be at USTR. He could go back to USTR. But, if I'm Robert Lighthizer, honestly, I'm looking for a slightly larger portfolio, a little bit of a bigger role, and that could be a commerce.
That's tariffs. Let's talk taxes. Let's talk about what can actually get through Congress and your view on what took place in the Senate in the last 24 hours. How constrained will this presidency be by a Senate that, for some people, stared down the president-elect and made its own decision about going a different way?
Yeah, well, I think we can all be sort of relieved and happy that it's going to be John Thune, who is, to his core, an institutionalist. So to the extent that it's not Rick Scott, John Thune presents a little bit more of a constraint. But, I mean, he's got 53 votes in the Senate, so I don't think it's going to be a huge constraint moving forward.
But Senator Thune has said he will not get rid of the filibuster. So basically, the only thing that the Senate can do with that kind of majority at 53 is tax and budget, correct?
Yeah, totally. We think it'll be a very big budget reconciliation package. They're talking about getting it done in the first 100 days of the term. I think that will be exceedingly difficult. We also have to realize, frankly, that we're running up to a budget cliff in December as well. So they're going to have to pass a CR in the short term with the current Congress. If they pass it out to January, February, they're going to have to deal with that first, a larger reconciliation package after that. But there's now talk about extending the CR to September, October, November to give them kind of that first 100 days latitude to get the budget reconciliation deal done.
So with Thune at the helm, what do you make of how the confirmation hearings are going to go?
Well, I think we can safely say, or at least I will predict that Matt Gaetz does not get confirmed as Attorney General. So he may wind up being sort of the sacrificial lamb of the cabinet picks. I think everybody else probably gets through. Again, Trump can lose one or two Republicans in any confirmation vote and still pass his nominees. So, Hegseth probably going to be a longer, more difficult process, just given that he's not really on the books regarding policy at all. I think Matt Gaetz is probably the one who's struck down, and everybody else probably gets through.
Hegseth and Gaetz, though, showed us that Trump is willing to nominate people who hadn't been on anyone's list. I don't think anyone expected either of them to be put up for these jobs. Does that show us that maybe we're too sanguine, that when it comes to Treasury Secretary, we'll get kind of a classic pick, a market-friendly pick?
On Treasury, I mean, I think it's going to be Besson or Lutnick, frankly. So to the extent that sort of hems us in, I think that's good news. But we have to be honest in saying that Trump received whether or not it was a landslide, I think is up for debate, but a national mandate, right? And he's going to put people into these jobs that A, he likes, and B, we're very loyal to him. And he's not really going to apologize for it. He doesn't have to apologize for it. He won the national popular vote. He's got a Senate majority. And so do I think we could get more surprises from here, or at least really more Trump accolades from here, whether or not that's a surprise? Yeah, I think we could.
But does Thune's lifting up as leader not show us that there is some resistance to some of Trump's ideas and who he wants?
There is some, I would say there is some resistance, or at least it's clear that the Senate isn't going to just roll over for Trump every single time, right? And I think John Thune he'll be a very good majority leader, he'll be a strong majority leader, and to the extent that he wants or has to stand up to Trump, I think he will be able to. That being said, though, on policy, right, on tax policy, on tariffs, et cetera, I think most of the Republican majorities in Congress are in line with Trump. So Thune is not going to stand up on policy. He may stand up on some of these personnel decisions.
When Trump went to the House the other day, when he also had the meeting with Biden, he brought Musk alongside him. I just wonder what the presence of Musk, who's become this huge donor for the Republican class, does to affect sentiment in Capitol Hill. Is there almost an element where they need to follow the money and that Musk represents a greater threat to them and maybe even funding challengers to those who don't support Trump?
Yeah, well, I think one of the biggest stories over the next 2 years may wind up being Trump and Musk falling out, just because it's two very talented political individuals, two very big egos in the same room together. That only worked for so long, right? So, it seems as though Musk is attached to Donald Trump's hip at this point. He's running this government. He has this government efficiency mandate now. We'll see how that goes. Do Republicans want to keep him on sides, at least until the midterms? Definitely. Will Trump be able to? Will keep him on sides and keep it friendly? I honestly think it's easier said than done.
Do you think Democrats could have avoided this if they'd shown as much love to Elon Musk as they had shown to Mary Barra of GM? Could this all have been avoided?
Yes, but I also think that in terms of Trump's not cabinet, but kind of broader universe, it was there for the taking from Musk. It was there for the purchasing, and to the extent that Democrats were nice or not to Musk, I think less important because Trump was able to give Musk really what he wanted, and that is power.
John brought up the Democrats. Yesterday, there was a report that the reason why Kamala Harris didn't sit down with Joe Rogan and tap his 15 million subscribers is because they were worried about the progressive pushback. How does the Democratic Party pick up the pieces?
Well, there's going to have to be a reckoning for sure. And obviously, in this global landscape, it's hard for any incumbent administration to get reelected, right? We haven't seen that happen across the board this year. So I certainly think Kamala Harris was running from behind almost from the get-go. That being said, Democrats have sort of installed this message that is incredibly left on social issues and actually pretty moderate on economic issues. And frankly, I think most voters want the opposite, right? They want a populist economic policy. They want an economic policy that's going to lift up manufacturing, lift up the working class. And they want to hear less and less about some of these social issues. And so I think Democrats essentially have to inverse the message.
The midterms are in 2 years. How do they prepare for that?
In these 2 years, I think it's going to be very hard to turn the party around 180 degrees, right? It's hard to steer a really, really, really big boat with a really, really, really big bureaucracy. That being said, I think for the next 2 years, essentially, they are going to tit for tat against Trump. They're going to be able to run against Trump in the midterms. Most of the time, an incumbent party does not do very well in the midterms, as you all know. I think for Democrats, the bigger issue, the bigger challenge is just what is the proactive, sort of positive message for their Democratic nominee. And it's going to be a major fight. We're going to see 10 to 20 folks in that nominee race. And so the question is, what is the message from the primary that emerges? It's 4 years from now. We just stopped talking about this.
I was going to ask you, have you got a name to watch? Have you got a name in mind?
I think Pritzker from Illinois is sort of my dark horse candidate. Not a DC figure, but he can be, Democrats' billionaire in relation to Trump. He's tough talking. He's come out post 2024, strongly in favor of many Democratic messages and strongly opposed to Trump. And I think it's a strong figure that's going to have to be at the top of the ticket for Democrats to compete in 2028.
Rob, appreciate it. It's good to see you, sir.
Thanks.
Thank you. Rob Casey there of Signum Global Advisors. We need to talk about this FX market. Next year, not much clarity. Very cloudy outlook. But where you have conviction right now is in foreign exchange. Most people believe the policies that will come out of this White House will lead towards a stronger dollar. And a stronger dollar is what's being priced right now. Euro dollar moments ago dropping to 104. Right now, 105.08, a new low for 2024 on euro dollar and seemingly heading towards parity. I cannot find a single person right now who is bullish on Europe. We'll have that conversation next. We'll catch up with Elsa Lignose of RBC on a rip-roaring dollar rally from New York City. This is Bloomberg. So a week today, we get earnings from NVIDIA, and then we won't be talking about a Trump election win and policies from the White House for the best part of 5 minutes. We'll be talking about the NASDAQ 100. NASDAQ 100 futures right now up by 0.1%, but once again, the outperformance on the small caps. And you know why. The small caps on the Russell right now up by 0.5%. In the bond market, really fascinating price action in yesterday's session, Danny. Just this tug of war between what was happening at the front end of the curve and what was developing further out along the curve on a 10-year. Seemingly, this Fed has got a bias to ease. And seemingly the CPI data of yesterday leaves the door wide open to cut rates in December. But for many people, that easing bias is contributing to longer rates pushing higher, and they pushed higher again in yesterday's session.
Right, because you get 50 basis points of cuts and we're off to the races. And that's even before you count in the politics. The market was happy to price in 80% odds that we will get a cut in December and have long-term yields jump. It's almost as if this market is talking out of both sides of its mouth. Part of the problem, John, is the Fed itself. We heard from a lot of Fed speakers. We hear from Powell today, and they're having a completely different conversation than the market's having.
Like Europe right now, having a very different conversation to the one that we're having stateside. The same policy producing very, very different, divergent consequences for Europe and the United States. Euro-dollar breaking down to 104 for just a second. Right now, euro-dollar 105.07. It's a fifth day of euro weakness, and we all understand the policy. Let's take tariffs. If America puts big walls up around its economy, most people assume that's going to lead to higher interest rates, higher yields, and ultimately a stronger US dollar. What it means for Europe, we've talked about this a million times. One aspect of this story, there is overcapacity coming out of China. Who's going to have to eat it? It will have to be the Europeans. What will this mean? Could mean a disinflationary bust in the European economy. And if you're thinking about divergent interest rates, the ECB has to cut a ton more than what you might expect from the Federal Reserve.
Yeah, but even before you get that, because of the stronger dollar, you get tightening financial conditions in Europe, and you get an ECB that needs to respond by cutting more. And then the dollar strengthens more, and then they need to respond more. It's this doom loop that, again, could also be exaggerated by China. The pain is in the euro because, for example, you look at the yen, that's at 156. It's under stress too, but not nearly as much as Europe. And that shows why this currency story, it's about trade.
Look out for Elsa Lignose of RBC in just a moment. Under surveillance this morning, President-elect Donald Trump nominating Matt Gaetz to be Attorney General. Gaetz resigning from Congress after the announcement, ending a House inquiry into sexual misconduct allegations against him. Trump also tapping Tulsi Gabbard to run national intelligence and Marco Rubio for Secretary of State.
So on that board right there, you have a conventional name like Senator Marco Rubio, which is going to get a lot of bipartisan support when he goes up for his confirmation. Then you have these unconventional, unorthodox names like Tulsi Gabbard, who's been a bit very friendly to Russia, an individual who has sat down with Bashar al-Assad and said he's not an enemy of the United States. And then, of course, there's Matt Gaetz. Terry Haynes put it best today. Trump's second time around started out looking like a more professional, focused, mature operation. Turns out that was on Monday. And when it comes to Gaetz, he resigned. And that means that House ethics investigation, which we now know from Punchbowl News on Friday, they were going to vote on whether they should make it public, that dies.
This is very distracting. This market is still very focused on one position, Treasury Secretary. You said to me the other day, and I want to share this quote with our audience because I think it's a good one, the producer of the show wants to be the star. And the producer of the transition team, the co-chair, is Howard Lutnick. And Howard Lutnick is putting his hand up, according to reports, and saying, I want to be the guy, I want to be Treasury Secretary.
Wall Street Journal front page is saying that he went to Trump and said, I want to be the Treasury Secretary. He sat around this table, and I've had conversations with him as well, where he said he is out there looking for the best names possible to staff this government. Well, it turns out he's looking to staff himself, which is why I said, he's the producer. He's supposed to be organizing the staff, but actually now he's throwing his name into the ring.
Who knows how well received that will be from Trump, but I do think it's a real risk we need to consider with Gaetz' appointment, with Hegseth, that we get someone totally unexpected. Just going back to the Gaetz point, literally everyone on Polymarket got zeroed out. Nobody was betting on him. I think there is a real risk that that could happen for Treasury Secretary.
Well, here's the thing, though. Then you look at the other most important cabinet pick. Arguably, for the market, the two most important cabinet pick is going to be Secretary of State, Secretary of the Treasury. Secretary of State went with someone that everyone in Washington is saying this is someone that is serious, this is someone of significance, and has serious depth on the policy issues. If you are President-elect Donald Trump and you know that the markets and we all sit around this table and talk about how he's regulated by the Dow Jones Industrial Average, if you know that those are the two most important places for where personnel means policy, that's maybe one where you're not going to take someone out of left field.
Which is why most people think still the favourite is Scott Bessent, right?
That's right.
Look out for that. Maybe we get an announcement. If you wanted to schedule this as a TV producer, when would you do this? Sunday night?
I would do
Tonight?
it either this evening before Friday morning, so we can all sit around this table and decide and talk about the horse race, or Sunday evening.
Hopefully we get it this evening. Let's talk about Republicans keeping control of the US House, scoring a trifecta in Washington. The win limiting curbs on Trump's power and making it easier for the party to enact potential immigration controls, reduce regulation and extend tax cuts. What can we get done with the slim majority that we currently have?
What we can get done with a slim majority is tax and budget. Everything else, through the Senate, which is going to be the main gatekeeper, would have to get over 60 votes. Right now, they can get what they want done on the budget through reconciliation with this slim majority. But other than that, it's going to be very difficult. But that's why the market likes it. They're straight away looking at tax cuts.
This is the trifecta this market was looking for at 7:30 on the evening of the election win of Donald Trump. I want to turn to the latest in the Middle East. The Washington Post reporting Israel is rushing to advance a ceasefire deal in Lebanon. Officials telling the Post Israel is aiming to deliver an early foreign policy win to President-elect Donald Trump, calling the potential deal a gift.
This comes after Ron Dermer, according to the Washington Post, went to Mar-a-Lago, an individual, Jonathan, you and I speak to quite a lot. This is the main brain trust for Benjamin Netanyahu. What's going to be interesting about this is the work is being done on this ceasefire with Lebanon agreement right now by Brett McGurk and Amos Hochstein of the Biden administration. So if they were gifted this when Trump walks into office, you're going to have both sides basically saying they're going to take credit for it.
This news cycle is moving so fast. Do you remember this back in 2016, 2017? I'd forgotten all about this. You step away from the phone for like an hour, you come back and it's just headline after headline.
Well, the other element to it that I think we all need to remember is that so much of the news happened overnight. I actually remember at the time that just even tracking the market, the volatility overnight was bigger than that during the day. So I think we need to get used to that also, maybe not sleeping or maybe waking up early and saying, oh, that's a new policy.
When President-elect Trump was 45, I was in places like Tehran, in Moscow, in Riyadh, where he would tweet and literally meetings would move. These oil ministers would freak out over what he was saying about the oil market and have to quickly go into another room and decide maybe we need to change our approach here because of the man we're dealing with.
He got a seat at OPEC. Not literally, but kinda. Let's turn to foreign exchange. Dollar strength continues in the aftermath of Donald Trump's election win. Euro-dollar briefly touching 104 this session. Elsa Lignose of RBC seeing more room to run for the dollar, writing, the fact that the US dollar is already strong creates a high hurdle for further gains, but a few things make us think dollar gains are not yet exhausted. Elsa joins us now for more. Elsa, welcome to the program. Share some of those things. What are those things that give you some confidence that maybe this is not exhausted?
But I think we first have to take into account what the starting point was, right? For some people, it was 112. That's where we were in late September. That, for me, is not the starting point. That was a condition where we were pricing in real weakness in the U.S. economy. People had freaked out over the softness in payrolls over the summer. People were talking about back-to-back 50 basis point cuts. That's not the neutral starting point. For me, the neutral starting point is 108. And bizarrely, we were at 108 just a week ago. I mean, I was here on Bloomberg with some of your co-hosts on 3 days after the election, and euro-dollar was just shy of 108, and it just felt strange, you know, with Trump having won effectively the trifecta, on track to win the House as well. The fact that euro-dollar was still sitting at 108 48 hours after the election didn't make a ton of sense. Now here we are, 105, as you mentioned earlier, 104 handle. We've gone further towards pricing in a more aggressive version of Trump. But as he's shown with some of his policy picks, this is not going to be a conventional administration. And so for me, there is still room for this to run a bit more.
Elsa, I can't find a single person that likes Europe or the euro. I mean, I like Europe, we all like Europe, but likes the European economy or the economy's currency. I'm looking at spreads, 2-year. The differential between Europe and the United States, that's gapped wider to 220. That's the spread between the front end of the German curve and the front end of the US curve. Back in September, that was as low as 135. So rates have done a lot of work already, Elsa. Do you think it's sufficient to sit here and say we've priced in a lot of the rate divergence, maybe it's time to get along the other side of the trade?
So, funnily enough, I was asked that same question a week ago, and back then I was definitely no way. Today, it's a little bit more two-way, but here's why I still think it has a bit more room to run. We've heard a lot of people talking about the German election and the room that creates perhaps for some fiscal stimulus. I do think you'll get some slightly easier fiscal policy out of Germany, but it's not going to be the bazooka, the game changer that leads to a real re-rating of European growth expectations. What we're talking about here in terms of tariffs, I don't even think Trump's necessarily going to go after Europe. But if he goes after China, we're talking about diversion of trade. Europe is going to be competing with China for that rest of world export market. And we know that a lot of Europe's growth in the last 2 years has been driven by exports, not by domestic consumption. So until that changes, until we see signs of that changing, I don't see this as having kind of run its course.
Elsa, which is the bigger loser here? Is it Europe and the euro, or is it Mexico and the peso?
But I think part of the reason people are positioning in the euro and a little bit more cautious with the Mexican peso is this is a trade that it's hard to time, right? Trump doesn't take office until January. A lot of the initial policy moves may take 2 or 3 months to fully play out. And so Mexican peso is kind of a difficult currency to sit in there and wait for it all to play out, paying the negative carry. With Europe, you don't really have that problem. Another one we haven't really talked about, the Korean won. You know, you have the intervention there, or the kind of perception that the central bank is really sitting on dollar Korea so that it doesn't move materially higher. But again, you don't have the negative carry working against you. And I think that is what investors are looking for at the moment, these positive carry trades that also benefit from potential escalation in trade war.
How do you disaggregate at the moment, especially when it comes to the dollar? How much of that is about Trump, is about preparing for tariffs? And it's just been the strong data we've seen, Elsa, has been the robust growth that we continue to enjoy in the U.S.
Right, and for me, that's why I said a lot of that move from 112 to 108 was really much more about the data than pricing in anything specific to Trump. I mean, I really think in the first few days after the election, a lot of investors I spoke to were either saying this makes no sense, or were saying he's not going to be a CEO, a kind of active interventionist. He's going to be more chairman. You know, as I think John said earlier, he's regulated by the Dow Jones. You know, if he pursues policies that aggressively weaken the equity market, then he'll stop and pause for thought. But the reality is there's actually quite a lot he can do that's quite damaging to other countries without damaging the US itself. If anything, helping the US, even helping in certain cases equities, particularly the small caps you mentioned earlier. And so for me, when you look at where we stand at the moment, a lot of what we saw through October was about the US data, the strength of the US data, even early November. It's only really now that we're starting to price in those more extreme Trump policies potentially.
Elsa, I'd love to get your thoughts on the yen as well. This morning we're at $156 yen. Do you expect some verbal intervention coming out of Tokyo?
Yeah, absolutely. And I think we've seen a little bit of that already with the comments from Canada earlier on in the week. The yen is an interesting one, I think, because it was the biggest loser last year, the year before, when we were seeing the real repricing of US rates. For me now, I'm actually a little bit more cautious. And you know we've been yen bears for a very, very long time. That's not to say that I don't see dollar yen going up. I do. It's just not the most obvious way to express the dollar strength for me in that kind of trade war world. Not least in part because if I look at the yield that Japanese investors are running on their overseas stock of assets, it has actually been creeping up over time. So unless you get the Fed actually back to hiking rates, then dollar yen is not the runaway trade to the top side that it was in years previous.
Well, then what's your favorite in terms of the top three to express that dollar strength?
So I do think dollar Korea has that real room to the top side. We've not really seen it yet. Euro dollar for me has a bit more room to run to the downside. Actually, for yen, I'd almost be taking the other side of that trade, not against the dollar, absolutely not. But Swiss yen is one we've been watching for a while. We dipped our toe into it. It didn't work initially, but it now appears to be breaking lower, breaking that rising up trend. And so that's one I've got my eye on.
Elsa, always appreciate your time. Thanks for this morning. Elsa Lignose of RBC, following a new low for the euro in the past 15 minutes or so on euro dollar, breaking down to a 104 handle. Moments ago, numbers from Disney, a beat on the top and bottom line, and the outlook, a 3-year outlook. Take a listen to this. Disney projecting high single-digit growth in earnings for fiscal 25, double-digit profit increases in 26 and 2027. That stock is falling just a touch. We'll get some more detail for you in just a moment. We're down about 3.6% in the pre-market. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Shares fell in Taiwan for key iPhone assembler Hon Hai. The reaction coming despite the company, also known as Foxconn, reporting stronger than expected quarterly profit. Boosted, of course, by high demand for its servers, powering our artificial intelligence. Putting a number on it, Hon Hai expects AI server sales to make up 50% of its total server business in 2025. But it did caution that its smart consumer products business will show a decline this year. Meanwhile, the Pennsylvania Senate race is headed for a recount. Right now, Republican Dave McCormick leads incumbent Bob Casey by around 30,000 votes, which falls within the range for an automatic recount. This is just over 80,000 provisional and mail-in ballots have yet to be counted. Casey's campaign has refused to concede the race despite multiple news outlets calling it for McCormick, who gave a victory speech in Pittsburgh yesterday. McCormick's win would give Republicans a crucial 53rd seat in the Senate. And New York Governor Kathy Hochul plans to relaunch congestion prices for drivers entering parts of Manhattan. The move coming months after she abruptly pulled the plug on a $15 charge just before it was set to start. Now she's expected to announce a new initiative today, this time with a $9 charge. President-elect Donald Trump opposes the plan, and with his inauguration scheduled for January 20th, the governor has limited time to avoid the incoming administration blocking the program. That's your Bloomberg Brief. John?
Yahara, thank you. This right here is why people don't like politicians. That right there, that story. They basically don't go through with it. They wait for the election. A week later, they start going through with it.
Well, they're going to have an opportunity at some point to vote politicians out or vote them in. I don't really see anyone in New York being on board with this congestion pricing.
Absolutely not. Up next on the program, inflation. Back in focus.
Right now, I think that inflation is headed in the right direction. I've got confidence about that. The bigger risk that I'd be concerned about on the inflation front is just if we're landing at around the 2.5% level instead of back down to 2% level.
That conversation up next, live from New York City. This is Bloomberg. Let's check out the price action together. Here's a snapshot. Equity futures just about positive on the S&P 500, up 0.1%. Bond yield still very close to 4.45 on a 10-year. Under surveillance this morning, inflation back in focus.
Right now, I think that inflation is headed in the right direction. I've got confidence about that, but we need to wait. We've got another month or 6 weeks of data to analyze before we make any decisions. The bigger risk that I'd be concerned about on the inflation front is just if we're landing at around the 2.5% level instead of back down to 2% level. I think that those risks existed before the election, and I think that there continues to be uncertainty now, and we need to just take our time, let the data come to us, and let that guide us.
So here's the latest. Traders adding to bets that the Fed will deliver another rate cut in December following yesterday's inflation data as expected changes from the White House cloud the outlook. Kelsey Berro of JPMorgan writing, the Fed remains on track to cut rates 25 basis points in December, even after cutting a total of 75 basis points at the last two meetings. The Fed still judges current policy as restrictive and the labour market no longer to be an inflationary force. We agree with the Fed's assessment of the current state. Kelsey joins us now for more. Key line there, Kelsey, and welcome to the programme. The current state. Do you disagree with the Fed on the outlook? Because you get to speculate, even though Chairman Powell says they don't.
Well, I think that the current state is really all that we can really know. Beyond that, I think there's just a lot of uncertainty about what comes next. And that's why when you look at 10-year yields, and a fair value model, just looking at the current inflation data, the current labor market data, and the path for the Fed funds rate prior to the election, that would have told you that the 10-year yield right now is fair around 3.5 to 4. Now, obviously, that's not the environment we're in. We're dealing with a lot of uncertainty, increase in term premium, a range in that environment where pretty much everything's on the table for now until it gets taken off the table. You have to anticipate a much wider range for the 10-year Treasury yield.
What kind of range?
4 to 5%. I know that is 100.
We're right there in the middle right now.
Right. We are right in the middle of it. And I think Where you will reach resistance is if you get to a certain level on 10s and a certain level on 10-year real yields, which I am watching. You're getting to around 2% on those, and that tends to be where risk assets start to wobble. I think you're going to see some resistance, and I think on the bottom half as well, you're also going to see some resistance. But we're still in this environment where anything is possible. And nothing has been fully taken off the table.
Well, to that point, we're going to hear from Powell today. Not only did he dismiss the politics, he dismissed the move higher in long-term yields. They're basically where they were when we last heard from him, so no reason to think he might be concerned now. But is this a bond market that's going to search for those levels, that's going to try to find those levels that does concern Powell and make him pay attention?
Not necessarily. It really depends on how the data is going to flow from now until the next meeting. So it was interesting, the reaction you saw to CPI. I think there was a lot of concern that CPI was going to come in hotter. Really, the debate we were having before the election was all about slowdown versus reacceleration. We're actually still having that debate today. That has not changed. So when you look at an inflation report that says, okay, things are fine, we're not worried about reacceleration, we're going to have the same back and forth and jitteriness ahead of the payrolls report as well. Now, we think that the more likely outcome is you're going to continue to see things slow down. You're going to continue to see things moderate. But in the event that things look like they're reaccelerating, and that's even before any fiscal stimulus, then the market will try to test the upper bands of those levels.
One asset class, though, that's been noticeably absent from this debate and is only caring about reacceleration is this credit market, with IG spreads at the tightest of this century. As we go back and forth in this debate, and if the reacceleration narrative picks up again, where does this market go? Can it really get any tighter than it is now?
I think it can. So this is the way that we've been thinking about portfolios. I was here on election day, and we were talking about the fact that we didn't have any information advantage to really be taking a directional view on duration ahead of the election, right? We were hoping to see some types of dislocation. Now, I think in the rates market, we haven't seen a lot of dislocation. The move has been fairly orderly. What are we doing instead? Well, in duration, if you're in a benchmark account, we're staying pretty close to home. If you are in an unconstrained account, move that duration somewhere else, like Europe, where I think the story is increasingly diverging from the US. But outside of your duration positioning, the one area where across the board we've continued to embrace throughout the year has been credit. And that's because, the most of the year, credit has been just grinding tighter because we've been in an environment of the soft landing. Now, we're still debating that soft landing, but we have the tailwinds coming from certain parts of the Trump agenda. So while I think we can debate from now and until the end of the show, the direction for Treasury yields, where we do have a lot of confidence is on the corporate fundamentals, the strength in the credit market. And the one thing that I've taken away from the last few weeks is there's always this battle between those who care about spreads and those who care about all-in yields. I think it's clear who's won that battle. It's the all-in yield buyers, right? They have been coming in. The demand has been incredible. And that's why in the month where we got the red sweep that everyone was talking about that was going to blow the bond market out of the water, high-yield total returns have been positive. Spread moves have offset the move higher in risk-free rates.
It's hard to argue with that. The market speaks for itself. Spreads are super, super tight right now, and they keep getting tighter. Kelsey, it's good to see you. Kelsey Berro there of JPMorgan Asset Management on both treasuries and on credit as well. The next month looks a little something like this. The payrolls report, December 6th. CPI, December 11th. The Fed decision, December 18th. This is going to fly by. That's basically the road into year-end and the holidays. Coming up next, we'll catch up with Mohamed El-Erian of Queen's College, Cambridge. We'll speak to Heidi Crebo-Rediker of the Council on Foreign Relations, Eric Lee of Citi on commodities, and Dan Ives of Wedbush on why Tesla is flying high. From New York City, this is Bloomberg.
There's a lot of unknowns out there, and the unknowns are all around inflation.
Higher tariffs, deportations, and fiscal stimulus That's going to tend to boost inflation.
What's getting a little bit messy is trying to figure out tariff impacts. And then you have the dollar moves on top of it, which makes it even messier.
The policy uncertainty is there, and policy uncertainty will continue. At the same time, the euphoria will continue for a while as well.
A tariff for a tariff will make the whole world poor.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now. Let's start with the price action. The outperformance on the small caps continues. The Russell up by 0.7%. The S&P up by only 0.1 in the bond market. Really interesting price action that we'll get our teeth into in just a moment. Yesterday, following CPI, 2-year yields declined. 10-year yields keep climbing. The 10-year stabilizing right now. The 10-year 4.44. The spread between Europe and the US bond market widening over the last week, and that's producing a much weaker euro. Euro dollar breaking down to 104 for the first time this year, a new low for 2024. That currency pair at the moment, 105.27. For the next 24 hours, this is where the attention will be in financial markets worldwide. We'll get some jobless claims data at 8:30 Eastern Time alongside the latest read on PPI. Then later on this afternoon, we'll hear from Chairman Powell at 3 p.m. Eastern Time on the outlook for the US economy.
I'm really interested to see whether he takes the bait at all to talk about these markets, because he can ignore all the politics all he wants, but the markets are sending a clear message. Lori Logan spoke about this yesterday. She said at some point they need to be concerned with the rise in bond yields because it's making financial conditions too tight at a time when they're trying to ease. Does it mean they'll need to ease more? It's a question she posed. Powell has stayed away from it, but maybe we'll get to the point where he can't avoid it.
This market is trading the outlook and speculating on the future of policy changes. And what did we hear from Chairman Powell in the last week or so? We do not speculate, which is why we're seeing so much daylight open up between how the Fed is talking about the future and how market participants are.
Well, the political economy is clearly going to be leading the central bank when it comes to 2025. They don't want to talk about it now, but they're going to have to start talking about it when there is going to be policy changes in Washington, D.C. What did we learn overnight? They were able to get this trifecta. The question is how big of the margin of that majority the Republicans are going to have in the House. But what they can do with a slim majority, Jonathan, has to do with taxes and has to do with the budget.
Priorities. What do you think the sequence is? What are the priorities now that trifecta is secured?
Well, the priorities for the market are very clear. Please get us that 14% corporate tax rate that you promised, even if with conditions. The issue is it could take a while for this to really turn through Congress, especially if you have a very slim majority. You can have 218 kings walking around thinking they're literally king of the hill and wanting something to receive for their vote. So potentially it could be tariffs because that Trump can do unilaterally.
Which is what a lot of people are looking for. Equity futures on the S&P 500 right now up by 0.1%. Gave you a snapshot of things in foreign exchange. The dollar has been strong. It is again this morning. Euro dollar down by 0.33%. A fifth consecutive day of euro weakness. Coming up this hour, we'll catch up with Mohamed El-Erian of Queen's College, Cambridge on inflation concerns. Heidi Crebo-Rediker of the Council on Foreign Relations as we await Trump's Treasury pick. And Ives of Wedbush on Tesla's post-election surge. We begin this hour with the equity market rally stalling and 10-year bond yields inching just a little bit lower as a tug of war between the latest economic data and expected policy changes from the White House clouds the outlook for the Federal Reserve. Joining us now to discuss is Mohamed El-Erian of Queen's College, Cambridge. Mohamed, welcome to the program, sir. I'm going to start yesterday. Going to go back to yesterday morning, 8:30 Eastern Time, CPI drops. We were looking for you and you weren't here. You're with us now. What's your response to that data, Mohamed? Because at the moment, the market is slowly gravitating to paying more attention to levels. The Federal Reserve at the moment seems to be more, I would say, gripped by the current trend and encouraged by it. What are you focused on?
So, John, sorry I wasn't with you yesterday. I was on the road. What I'm focused on is actually summarized really well by John Authors of Bloomberg Opinion. I'm a big fan of his daily note, and today is a very thoughtful note. And he basically leaves you with three messages. One is the fall in inflation is stalling. Two, if you look at the components, they suggest that it will continue to stall. And three is that if you look at the work that's being done in the different groups of economists within the Fed, they also confirm that we've got a 3% inflation rate. Now, as you know, I think the equilibrium inflation rate for this country is between 2.5% and 3%. If you continue to target 2%, then you're going to have some really difficult choices. And I think that is what's facing the Fed right now.
Do you think they're also slowly realizing, Mohamed, with that in mind, that they're not actually as restrictive as they think they are? And are you seeing evidence of that start to creep into some of the speeches you're hearing from Fed officials?
Yeah, I think they're backing away from the view that they expressed in their last meeting. And I think that what we're getting is, you know what, maybe I can live with 2% plus for a while, because otherwise they are in a really difficult situation. Look, the market was relieved because the market didn't look at the fact that core inflation is stuck at 0.3 monthly for the third straight month. The market was worried that the numbers would be higher than the consensus forecast, and that didn't happen.
In the components, though, the BLS reported that over half of the inflation we saw, Mohamed, came from shelter prices raising. Claudia Sahm said we don't have an inflation problem now, we have a housing problem, and that's been true for over a year. We've seen the Fed cut rates and mortgages move higher. Mohamed, how do you solve an inflation problem if it's underpinned by a fickle housing market?
So I don't think that's the only issue, Danny, but it's an important issue. And again, I'll point you to John Author's note. You can tell I really like it because he does such good detailed work.
We love John too.
Where he looks at trimmed measures, where he looks at all that. The problem is services. And within services is wages. It's a good thing for the average American that real wages are growing by more than 1% now. That's a good thing, but it's feeding into services. And that's the big issue. And it's happening at a time when grocery inflation has come down a lot, where there are negative price increases for certain food items. And the concern is that services aren't going to come down fast enough inflation-wise before goods inflation starts going up.
Mohamed, if we're going to be in an environment where trade potentially is the priority of this White House, tariffs are put on, and American companies abroad are forced to come back, and they're forced to pay American workers, is this problem not going to get a whole lot worse?
Yeah, so I'm in the UK here, Danny, where everybody, the companies have found it totally normal to say the minute my costs go up, I'm going to pass it on. And you hear that over and over again from companies in reaction to the budget. So there is this mentality right now in the corporate world that forget about your profits, forget about all the dividends and all the share buybacks you do. If your costs go up, then you should pass it on to the consumer. So there is that risk. But I want to stress that it's really hard to model what the president-elect's economic promises. First, you have to decide how many are going to be implemented. And then you have to decide the two counterforces. Yes, tariffs are inflationary. Yes, higher budget deficit will tend to put pressure. But on the other side, you have a major deregulation. And on the other side, you have a major promise to act on the expenditure side of the budget. So when you look at these two things, the first, even when you try to net it out, it's not clear. And then the second round effects get really complicated. And I tell people, regardless of what happens, we now have an inflation that's not going to go to 2%. Now, before you jump immediately to what's going to happen next, understand that you got to wait because it's really complicated economics sorting all this out.
Mohamed, you have a new piece out today, and you say, once again, it was the economy stupid and Project Syndicate. And I think, and you can tell us here, are you trying to answer a question that our own colleague Craig Torres asked Jay Powell in the press conference, which was, did you learn anything about Americans think about the economy from the election results?
Yeah, and Marie, it's fascinating because there were two economic messages sent, and they're both correct. There was the one that the Republicans pounced on, repeating the 1980 Reagan question, are you better off? And they were talking about the price level. And people really still have sticker shock when they go to the grocery store. So that is what the average person focused on.
Well, you ask a question as well in your piece. Will the Democrats and establishment, in quotes you put, experts, get the message? Will they?
Well, they haven't so far because they're focused on the economic exceptionalism, which is also true. But in a K-shaped economy, that doesn't trickle down as much as you'd like it to. So the Democrats stuck with the economic exceptionalism. They didn't understand that that message wasn't getting through for good reason, because people were concerned about the price level. And you know, Anne-Marie, that the more you tell somebody a message that doesn't speak to their reality, the more they question you, the more they lose trust in you. And the economists did a terrible job, the mainstream economists did a terrible job of trying to reconcile the two views, which are reconcilable. But unfortunately, the reality is that people will continue to focus on the price level because it has been such a large shock. We're not used to seeing inflation at 9%, which is where it was in June 2022. And that impact hasn't gone away.
Mohamed, what are your thoughts on the price action? Let's talk about that a little bit. Ahead of the election, you were looking at what was happening in the bond market and the high yields, and this line came up in your Bloomberg opinion column. While most analysts agree on the list of potential contributors to this unusual development, the Fed's cutting interest rates, yields are rising, there is little consensus on their relative importance. You went on to say that over the next week, we should get some clarity on that. Do you have clarity now on what is driving long rates?
I have more clarity on what's driving long rates, and it's exactly what you have been talking about. The market is front-running economic announcements, including who's going to be in Treasury, and that's going to be really important. And I agree with Anne-Marie earlier today, saying that that really matters. You see that the economy has continued to surprise on the upside, and that has had an impact. Meanwhile, in Europe, and I'm glad you've been focusing on the FX situation, things have gone in the opposite direction. John, the yield differential between 10-year Treasuries and 10-year German government bonds, the Bunds, are back over 200 basis points. That's been a massive move. And the market has understood that divergence is a major story going forward.
Mohamed, how much more divergent could things possibly get? We've already seen aggressive widening over the past week. I was mentioning in a conversation earlier this morning that the front end, if you compare the German 2-year to the US 2-year, only back in September, that was trading around 130. Now it's up like 220. So almost a 100 basis point move on that spread, Mohamed. How much wider can things get?
I think they can get wider, John. I think, if you look at the good, the bad, and the ugly of the global economy, unfortunately, Europe is in the ugly. Cyclically, they're challenged. Secularly, they're challenged. There is no definitive political leadership in the two countries where you need it most, Germany and France. There's a roadmap, the Draghi report, but they're nowhere near even talking about implementation, let alone implementation. And these dynamics today mean that if you're lagging, you are likely to lag even more. So, John, it wouldn't surprise me if you see that differential go higher. It wouldn't surprise me if you see the euro go weaker.
So that makes it easier, relatively speaking, to call the ECB for 2025. They're going to cut interest rates. Mohamed, there is overwhelming consensus the Fed reduces rates again in December. I would love your base case for 2025 before we get to the end of the year, how you're thinking about how much work this Fed can actually do, and whether you think ultimately, just in terms of how the communication has evolved over the past few days, we're setting ourselves up for a pause into 25.
So first, I agree with you that we are likely to see another 25 basis points cut in December, and we should see another 25 basis point cut. Longer term, the range, if you look at the dots of where's the terminal rate, where from about 3.5 to just over, from 2.25 to just over 3.75. And I've argued it's towards the upper end. I suspect that now is about 4%. That is the terminal rate for where we're going. So we will have a couple more cuts, and then it gets really hard to cut more, unless you're willing to have the difficult discussions. And this is not a Fed that's willing to have a difficult discussion. This is a Fed that will continue to stand behind this notion of data dependency. And this is a Fed that may be bailed out on inflation by what's happening away from it, and bailed out in the wrong way, meaning that inflation doesn't go to 2%, and they'll just say it's not our fault.
Mohamed, I could talk to you all day. We all could. What do you mean by the difficult discussion? What is the discussion that you'd like the Federal Reserve to have as soon as today? What would you like to hear from Chairman Powell at 3 p.m. Eastern time that you're not expecting to hear?
So I'm definitely not expecting to hear the question, is 2% still the right inflation target? He's not going to touch this. Hopefully behind closed doors they are, because even if you don't want to change your inflation target, and they won't change the inflation target, The path to that really matters. So I'm hoping that they're having a discussion. What is the right neutral rate in this economy right now? What is the right inflation target? That discussion, if you had it without the historical context and without the legacy of having missed so badly on your inflation target since 2021, would be it's more between 2.5 and 3, and that's probably the range it should be. But that's not a discussion that he will ever have publicly, not this Fed.
Mohamed, it's good to hear from you, sir. Appreciate your time. Mohamed El-Erian there of Queen's College, Cambridge. Thank you, sir. Mohamed mentioned John Author's column a few times in that conversation. You can find that on Bloomberg.com and, of course, on the Bloomberg terminal. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Disney shares are rising in the pre-market, nearly 7%, after fourth quarter sales and profit beat Wall Street estimates. The star behind its solid results was the company's streaming business, with subscribers for Disney Plus climbing to over 158 million. Disney also saw strong growth from its film studio thanks to hits like Inside Out 2 and Deadpool and Wolverine. As for the outlook, Disney projecting double-digit profit increases both in 2026 and 2027, underscoring the turnaround efforts put in place by CEO Bob Iger. Meanwhile, Capri shares are lower in the pre-market and Tapestry shares are rising some 6.6% after the fashion companies agreed to call off their merger. The $8.5 billion merger is set to end after a U.S. court froze the deal due to objections from antitrust regulators. Tapestry, the owner of the Coach and Kate Spade brands, had wanted to join forces with Capri, whose biggest brand is Michael Kors. But the FTC opposed the deal on grounds that it would harm competition in the market for accessible luxury handbags. And crypto predictions betting platform Polymarket is under investigation by the Department of Justice. Sources telling Bloomberg the platform allegedly accepted trades from U.S.-based users, which violates an agreement with the Commodity Futures Trading Commission. The FBI searched the company's CEO's apartment and seized his phone, this coming just over a week after the election betting platform successfully predicted President-elect Donald Trump's win. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next, the transition begins.
Looking forward to having like we said, a smooth transition. Do everything we can to make sure you're accommodated.
I appreciate it very much. A transition that's so smooth, it'll be as smooth as it can get.
We all had the same question. Who lit that fire? We all want to know. What was that about? That conversation coming up in a moment. From New York, this is Bloomberg. Equity futures on the S&P 500 right now positive by 0.1%. Later on this morning, PPI data and jobless claims. That data 1 hour and 10 minutes away. Under surveillance this morning, the transition begins.
Mr. President-elect and former President, thank you, Donald, congratulations.
Thank you.
And looking forward to having, like we said, a smooth transition. Do everything we can to make sure you're accommodated, what you need. And we're going to get a chance to talk about some of that today.
Politics is tough, and it's, in many cases, not a very nice world, but it is a nice world today, and I appreciate it very much. A transition that's so smooth, it'll be as smooth as it can get.
So here's the latest. President Joe Biden hosting President-elect Donald Trump in the Oval Office, calling for a smooth transition. As multiple reports indicate the man overseeing Trump's transition team, Cantor Fitzgerald CEO Howard Lutnick, is making a late play for the role of Treasury Secretary. Joining us now is Heidi Crebo-Rediker of the Council on Foreign Relations. Heidi, welcome to the programme. Anne-Marie said it a million times. People, a policy. What are the signals you're taking away from the current transition?
So first on the transition, I think the irony of the conversation between President Biden and Trump is that the incoming Biden administration had anything but a smooth transition. It was actually a complete restriction on access to various agencies, having been on the other side of that. So I think there's quite a bit of irony in that statement. But yeah, I think we've had quite a few surprises in the past 24 hours. And for Treasury Secretary, everybody's jockeying in the press and lobbying the president and his advisors for this very, very key Treasury Secretary position. But I will say, given the past 24 hours, I would be open to surprises that are on nobody's bingo card. We've seen, in particular, the naming of Matt Gaetz for Attorney General and Tulsi Gabbard for Director of National Intelligence. Those are two very big surprises to, I think, a lot of people.
Trump did name, though, a conventional pick when it comes to Secretary of State Heidi, and of course that's Marco Rubio. So maybe when it comes to Treasury, we would get a more conventional pick because Trump does care about who is going to be the leading voice, especially for financial markets. If it does come down to Howard Lutnick and Scott Bessent, who do you think the financial markets would like to see?
I think either one of them would be a welcome pick, but I'm in the same position as you are in speculating as to which one is more likely. The challenge, I think, with Scott Bessent is that he might be perceived as not fully on board with the very significant tariff policy that's coming down and the use of tariffs as a sort of as a bludgeon that's coming down the pike right now, because that is absolutely where President Trump is. And if you see a Treasury Secretary walking that back in the running for the job, I'm not sure that's going to play to his advantage.
Well, he might need to regulate Bob Lighthizer, Ambassador Lighthizer, somewhere in the administration. Where do you think Trump would be placing him?
So I think, he will certainly play a prominent role. He's the key behind the scenes on crafting the tariff policy and trade policy for the president. And if he has sort of a general senior cross-agency platform on trade, then that puts him in a powerful position. But also, he won't have all of the resources of, say, an agency that he would govern directly, like USTR or the Treasury Department. So it does also come down to sort of who has authority, who has resources in those positions. But he certainly he will be Trump thinks of deals, and on deals you have lawyers, and Bob Lighthizer is sort of the chief lawyer on all of the deals that Trump plans to do using tariffs.
Heidi, you mentioned some of the more surprising picks from Donald Trump for his cabinet, and including ones like Gaetz that's polarizing even within the Republican Party. What do you think the confirmation process is going to look like? How easy or difficult will it be to get some of these nominees through?
Look, I think this is a huge loyalty test to the Senate and to the incoming to Senator Thune and the incoming Republican leadership. This is, the Senate has a serious advice and consent role that's meant to check the balance of the presidency, and it's something. It's in the Constitution. Trump has asked for as a loyalty test for the Republican Senate to basically bypass this process and just use recess appointments, so there would not be confirmations. And I think that is going to be extremely, extremely difficult. We have a lot of. Sorry, go ahead. There's a lot of attention on Matt Gaetz. For very good reason. He's super controversial. He took down Kevin McCarthy. I think there's a very big chance you're going to see a lot of leaks around a Gaetz nomination. And Tulsi Gabbard, that's a risky choice. It's a risky foreign policy choice because she doesn't have the intelligence background. And if going
to be some tight decisions to make, Heidi. We're just coming up against commercial breaks. We've got to run. Heidi Crebo-Rediker there, the Council on Foreign Relations. Thank you from New York. This is Bloomberg. So in 60 minutes' time, we'll get some PPI data for you and jobless claims as well. In 2 hours' time, we've got the opening bell. Equity futures right now on the S&P 500 higher by 1/10%. With some morning movers, it's Manus Cranny. Morning, Manus.
Jonathan, very good morning to you. Two very different sets of guidance. Let's dig into the Cisco guidance. First of all, a little bit lighter than the market would have liked. They're going to make 55.3 to 56.3. That is lower than the estimates. They're battling inventory build-up and slower government contracts. When it comes to, of course, the magic words, sprinkle dust, AI, Chuck Robbins say infrastructure is going to make it made $300 billion in this quarter. It's going to make $1 billion in 2024. So that's the magic of AI to come. A different set of guidance. This time, Bob Iger trying to sprinkle a little bit of a whole new world over at Disney. High single-digit adjusted earnings per share growth 2025. They don't typically give guidance. They've given for 25, 26, and 27. You're seeing double-digit growth in the entertainment business, some cracking movies, Inside Out, Deadpool, and Wolverine. So that helped them there. Experiences, it's interesting. You know, think of the theme parks. Tough time. Paris Olympics was on. Two massive destructive hurricanes, Helene and Milton. So that just gives you a flat number there. But I go to the New York Times, stunning line on linear TV. It's atrophying, income down 38%. The deal, Lena Khan, she blocked this deal between Tapestry and Capri. Capri is down 5.5%. That dominance in the handbag world, it's going to be a free-for-all, quite literally, in the handbag world. Get ready to grab your market share. But what happens next to Capri is the critical question. Tapestry is at the bottom of your screen. They're going to do a $2 billion buyback. They're trying to soften the blow. The big question in my mind, how long does Lena Khan last at the FTC in this next administration? And what kind of a bid would that give to the tech world? You can ask your next guest that.
Manus, our next guest is an oil guest, but maybe we'll ask Dan Ives a little bit later when we catch up with Dan. Are you dropping Aladdin lyrics into your market checks now?
Why not? It's a whole new world here.
Thank you, Manus.
Thank you.
If you don't know, Manus sings before the show begins every single morning.
Yeah,
Started in London, continues in New York.
Honestly, it's wonderful. Everyone should watch the 5 a.m. And the reason that I'm laughing at every start of the 5 a.m. is because Manus will have just sung to me.
Disney songs exclusively.
Yeah, mostly.
I'm not sure what that's about. Under surveillance this morning, US officials accusing Chinese state-sponsored hackers of a, quote, broad and significant cyber espionage campaign. The hackers allegedly stealing customer call records from AT&T and Verizon. The New York Times reporting that Donald Trump and J.D. Vance, as well as Harris campaign staff members, were also targeted.
So I was reading through this release yesterday from the FBI, and they're talking about also private communications of a limited number of individuals who are primarily involved in government or political activity. So you can see there the two campaigns. What's interesting is Jake Sullivan over the weekend was asked about this on Face the Nation. And he said, of course, every single American official that sits down with their Chinese counterpart will bring this up because it is a significant attack. Well, guess who's sitting down with Xi Jinping on Saturday? President Joe Biden.
I have to say, rarely does a week go by and we don't get some sort of warning from some Western intelligence official that China is looking into something. I was looking at this journal piece and it really just underscored how unprepared we are. They cite that for every China-backed hacker, there is 50 of them to one FBI cyber personnel. We are so unequipped from the growing threat. And it's going to be a really tricky situation because most countries can't afford to throw out a Chinese diplomat or put on sanctions. Of course, we're going to get some sort of round of that with Trump. It'll be interesting to see what sort of balance he tries to strike.
This cabinet's going to be packed full of China hawks. Hegseth, China hawk. Rubio, China hawk. The list goes on.
Also, his national security advisor, Representative Walt, China hawk, who is an individual who was for the TikTok ban and who said TikTok is Chinese espionage in an app for social media, something that Donald Trump has wavered on and doesn't want to actually block. He's worried about competition. But the individuals around him, the personnel around him, they are China hawks, and they are individuals who want to see something like a TikTok ban.
The to-do list is so long. Let's get you the latest on this next story. Nippon Steel's vice president is set to meet with Pittsburgh steel workers next week as the Japanese firm continues to make its case for a U.S. steel takeover. The visit coming as both companies await a decision about Nippon's pending transaction. President-elect Donald Trump saying on the campaign trail he will block the deal.
He said he will block the deal. Joe Biden says if it gets to his desk, he will block the deal. Right now, it's still living in the CFIUS purgatory, pretty much used, as you could speculate, that CFIUS was used to basically have a hiding place for this deal because they didn't want to disrupt the election and those crucial votes in Pennsylvania. But while it's still in CFIUS, and we're waiting for that to come out, you see Nippon Steel trying to get ahead of it. They're going to the union plants. They want to go to the factories talk to these workers, maybe there's a window where something can get done.
And just finally on Meta, Meta will face a scaled-back antitrust trial over its alleged social media dominance. A federal judge narrowing the FTC's claims but rejecting Meta's main argument that its acquisitions of Instagram and WhatsApp were good for consumers and not an effort to monopolize the market. Manus mentioned what's going to happen with tech. It's a big focus for the likes of Meta.
And, of course, who is going to be leading the FTC? Lina Khan, actually, her term is technically over. She just stays on until there's a new chair appointed. It is likely not going to be Lina Khan, even though J.D. Vance has said she's one of the few individuals in the Biden administration who's doing good work. But take this lawsuit, for example. It was actually filed under Trump 1.0. It was filed in 2020, one of two by the first administration to curtail the largest of the U.S. tech platforms.
You know, going all the way back to when those transactions were made, I think we've got to go all the way back to when those transactions were made. I remember that morning in London and going on European TV, and we had a whole host of guests who thought they were overpaying for the asset. That's how people thought about the transaction at the time. They thought they were overpaying for the asset. And here we are, 10 years plus later, and we're sitting here saying, oh, yeah, shouldn't have allowed that to go through.
Because they're pervasive now. WhatsApp at one point was young. Not a ton of people were using it, especially just in Europe. Now, actually, it's used more pervasively around the world, even in the United States.
Yeah, but, I mean, there's TikTok. This isn't a monopoly, right? Like, there is real competition. And President-elect Donald Trump has mentioned this as to why he wants to keep TikTok around. I think this speaks to what kind of environment are we going to have? Sure, these were filed under President Trump, but maybe it's just less energy is put towards these, that there are less appeals. More things are kind of allowed to fall by the wayside because, again, Trump, I think, doesn't see it as a monopoly because there is TikTok.
Dan Ives of Wedbush joining us shortly. Look out for that conversation. Here's the latest elsewhere in the commodity market. Brent crude at the moment, 72.64. WTI, 68.79. Eric Lee of Citi writing the following. A Trump presidency and red sweep is likely to be marginally net bearish for oil in the base case. And as oil's fundamental outlook was already bearish, we continue to see Brent oil prices averaging $60 per barrel during 2025. I'm pleased to say that Eric joins us now for more. Eric, good morning to you.
Morning.
Marginally net bearish. What is it about this presidency that is marginally net bearish?
I mean, there's three big things out of many things. One is trade tariffs. They're, generally speaking, negative for the economy, negative for oil demand. Second of all, a second Trump administration is looking at releasing the fetters of the U.S. oil and gas industry. There might be, on the margin, some more supply. That's net bearish for oil. And then thirdly, he claims a stronger relationship with OPEC Plus, maybe getting them to release more oil to the market as well, especially he's talked about halving energy costs. Now, the other side of the ledger is people's concerns over whether there would be harsher sanctions on Iran, and that would cut supply there. But it's looking like that might be less of a probability at this point in time.
Your second point, Donald Trump would call drill, baby, drill. What is the break even where Donald Trump thinks it's acceptable for consumers to have a low enough price but not bust the shale industry?
Well, I don't know that number in terms of what's in his head, but in terms of the U.S. shale industry, you could probably be at $50, $60 prices, and that would be the point where the U.S. oil production would probably flatten out and stay flat on a sustained basis.
What kind of production do you think OPEC is willing to add to the market? Because today we have IEA data that says the market faces a surplus of more than 1 million barrels a day next year.
Yeah, we've been calling for this kind of view really since earlier this year. That drives our $60 price view for next year. What is OPEC Plus willing to take? I mean, it's hard to say. Last year, the year before, Saudi Arabia and other producers were reacting at $90 oil, $80 oil as a kind of floor. We're now in the 70s. There are a couple of important producers in OPEC Plus that are probably itching to use their spare capacity. The UAE, maybe even Russia over time as it's developing its production capacity as well.
Well, we even just saw Kazakhstan recently overshot its oil output under OPEC Plus. It is a Saudi that's had a difficult time exerting that leadership. We saw in the first Trump administration, he was able to kind of come in with sharp elbows and get them to do some things that he wanted. Does he possess that ability with Saudi now when they're still struggling to contain the bloc?
Yeah, I mean, on the Saudi side, it seems like in a sense, part of the group's agreement to start unwinding cuts in January, which they might postpone, but the agreement to do that's probably in part hinging on the fact that these producers need to comply more, right? Iraq, Kazakhstan, Russia, and to some extent they have. Other than that, these producers, I think, are itching to bring things back. And other than that, if prices keep moving lower, supply outside of non-OPEC Plus is growing fast, demand is weak, it may be tough for them to continue to hold prices higher.
So much of this also is going to be down to geopolitics. I know a lot has been gone back and forth, a lot of volatility as to whether we price that in or not. What sort of environment do you think we'll be dealing with the Middle East, with Trump coming into the White House?
There are concerns over Iran. May there be harsher sanctions on Iran? What would that mean for Iran's production and exports? Would that tighten the oil market? That might come at the same time as OPEC Plus releases oil to the market with encouragement from a Trump administration. So it could be offset. Similarly for Venezuela sanctions. And then on the other side, if there is a quicker resolution to the Russia-Ukraine crisis in some way, that could ease energy prices as well.
Eric, but what Iranian sanctions aren't ready on the books? The sanctions are there. Mm-hmm. Will this Trump 2.0 have the appetite to enforce them?
That's a great question. Right now, Iran is exporting somewhere around 1.5 million barrels a day. Sanctions have been on, as you say, for a long time. More sanctions were put on fairly recently by the Biden administration. It's gotten to a point where most of the buyers of oil are Chinese teapot refineries that are not particularly exposed to the US financial system. And that's the main source of leverage for these sanctions. So unless there's a different tool that might be wielded for this, it may be tricky to reduce Iran's oil exports that much further. Maybe somewhat, but not that much further.
Eric, a lot to think over. It's good to see you and catch up. Thank you, sir. Eric Lee there of Citi. Brent crude at the moment, 72.71. WTI, 68.84. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. LVMH reshuffling its divisional leadership. Bernard Arnault's son, Alexander, moved to the luxury giant's Paris headquarters and will become deputy chief of the wine and spirits division. He was previously at the New York-based jeweler Tiffany & Co. LVMH also names a new human resources head after the previous head left the company. This fueling more succession speculation as Bernard Arnault remains CEO, but his children all have key positions at the group. Klarna filed for an initial public offering in the U.S. The Swedish payments firm submitted a draft registration statement to the SEC. The number of shares and the price range have not been determined, but the implied valuation is about $14.6 billion. Sources tell Bloomberg the IPO is expected next year, and the company is working with Goldman Sachs, JPMorgan, and Morgan Stanley to arrange the offering. And New York renters no longer have to pay broker fees when signing a new apartment lease. In a new measure passed by the City Council on Wednesday, the Fairness in Apartment Rental Expenses, or FAIR Act, was approved. Landlords who hire real estate agents will have to pay the agent's fee themselves instead of passing them on to tenants. There is a 30-day window for the mayor to sign the act into law, and it will take effect 180 days after. That's your Bloomberg Brief. John?
Yahara, thank you. I'm not in a position to advocate for things, but good. Up next, supercharged by a Trump win.
America is going to reach heights that it has never seen before. The future is going to be amazing.
Come on up here, Elon. He created the first major American car company in generations. Come here. Take over, Elon. Yes, take over.
And that stock absolutely surged over the past week. That conversation up next. Live from New York City, equity futures right now positive by 0.1% in the bond market going into PPI data and jobless claims later this morning. That data drops at 8:30 Eastern time. The 10-year at the moment down almost a basis point, 4.44. Under surveillance this morning, supercharged by a Trump win.
President Trump is the only one who can save democracy.
America's just not just going to be great. America is going to reach heights that it has never seen before. The future is going to be amazing.
Where is he? Come on up here, Elon. He created the first major American car company in generations, and his rocket company is the only reason we can now send American astronauts into space. Come here. Take over, Elon. Yes, take over.
So here's the latest. Tesla shares surging nearly 40% over the last week as President-elect Donald Trump awards his ally Elon Musk a role overseeing government efficiency. Dan Ives of Wedbush seeing upside ahead, writing Trump will fast-track the autonomous and AI initiatives. In our view, over the next 12 to 18 months, that will be a game-changer to the Tesla story. Dan Ives joins us now for more. Dan, good morning to you. Let's talk about these numbers. Up 36%. In 7 trading sessions, that's $280 billion of market cap. We're talking like 5x of Volkswagen. Doing that in a week. Why?
Get the popcorn out. I mean, I believe this is just the beginning.
That's an expensive movie.
I think it's just the beginning because of the autonomous and AI piece. And I ultimately believe now with Trump in the White House and Musk a very big seat at the table, this is the start of what I believe is autonomous is going to get fast-tracked over the next few years. And when I believe the AI autonomous piece alone is worth $1 trillion of valuation to the story.
Let me jump in. You say fast-tracked. What does that mean? Fast-tracked by who?
Well, if you look on the federal agency side, I mean, even there are some things in the state, that's really been the spider web that I believe has been holding the autonomous FSD and a key part of the valuation for Tesla. Because my view is if you start to significantly increase FSD penetration, and you look at Cybercab, where Street doesn't even think that's coming out till 2027, 2028. You fast track that 2 years, you look to ultimately see now the autonomous story really play out. I don't believe any autonomous valuation is factored into Tesla, even today.
It's got to work, though, and they've already got a playground for it, California. Have they demonstrated it works? Are Waymo doing a better job?
Look, when you look at Waymo, ultimately the scalability for Tesla is what I believe is the key. And I think when you look at this latest FSD, when you look at the latest version, and you look at what I believe what we're going to see over the next 6, 12 months, I believe autonomous, when we talk about level 4 and true autonomous, we get to the end of next year. If regulatory spiderweb disappears, which I believe now it is, I think this dramatically changes the Tesla story. And I believe we're going to be sitting here talking about Tesla $2 trillion and so on as the AI and autonomous piece play out. Because I think for Musk, this is a bet for the ages on Trump. And ultimately now he essentially becomes not just a big seat at the table, but someone that's going to have a huge influence even when it comes to China tariffs and others.
But this Department of Government Efficiency has no authority. It has no money. They are just going to make recommendations. So are you really actually just betting on Elon Musk's proximity to power?
I mean, look, this is, I think, just the first start. Because I think he's going to be essentially AI ambassador. He's going to have a huge piece when it comes to China tariffs. And he is going to be essentially...
That's an important point. Why do you think he's going to be a huge piece when it comes to China tariffs? Ambassador Lighthizer on board, big China hawk. Senator Rubio's coming on board, big China hawk. You think someone outside the government, in Elon Musk, with a fake department, is going to have some influence on tariffs on China?
I think there's no doubt that he's going to have an impact on tariffs because everyone understands, even within the Trump transition team, and tariffs, the key is they could talk tough on everything else. But when it comes to chips, Tesla, Apple, that's the crux of the AI revolution, and it's the crux of big tech. And I think part of why you see big tech so resilient, besides, I think the consensus view that Khan's out, it's just a matter of when the press release hits, is that ultimately this now lays the groundwork for tough on tariffs, but I believe there will be carve-outs when it comes to Tesla, Apple, and others. And I think Musk, no one understands the jigsaw puzzle of China as well as Musk, and of course,
Dan, have you seen the reports that Elon Musk is wearing out his welcome around the Trump transition team?
I mean, look, as someone that, I feel like I have a pretty good pulse on the whole situation, I strongly disagree. I think this is actually an alliance in terms of Musk and Trump that gets stronger, not weaker. So our whole view is that I think we sit here a year or two from now and being like, why is Musk now involved in X, Y, and Z? Now, in terms of the balance and what that can mean, given Tesla, given SpaceX, Tesla investors, and it's part of, as Farrell talked about what the stock's done so far, I think it's justified because it's a new age, a golden era, not just for big tech with regulation gone, but I think for Musk and Tesla.
It goes beyond Tesla. I mean, Elon is sparred with a lot of government agencies when it comes to SpaceX. He's called on the FAA chief to resign. He's sued the National Labor Relations Board. He's accused the California Coastal Commission of targeting SpaceX. Are we going to see some real changes with that type of enforcement for SpaceX?
Think about it like Musk was a student and he's essentially in detention, the teacher of federal agencies. Now, all of a sudden, he becomes the principal, essentially. So this is going to shift things a lot in terms on the federal side. I think a lot of the federal spiderweb, I'm not saying there's still going to be issues there. A lot of that disappears under a Trump presidency. And I think Musk is going to have an outsized influence when it comes to a Trump presidency, which is key for Tesla, because ultimately when it comes to Tesla, this is going to be one where you could say, even when it goes to Twitter and X, you talk about $30 billion that maybe he lost on that, but he gained what I view is probably $1 trillion or $1.5 trillion of value when it comes to this, in terms of this Twilight Zone jigsaw.
So you say he's going to move to this principal role, and he's going to have this proximity to the president-elect. We already see that proximity. Is it appropriate then that he does not divest his personal financial holdings, even though he's going to have such an influence, you say, on American policy?
Look, and ultimately, until it's not an official cabinet position, so there's no change that needs to be in terms of CEO, in terms of his stock ownership and everything else. Will there be noise? Will there be, will there also be criticism? Yeah. But I believe this is something where the benefits far outweigh the negatives. And that's why it's like, look, right now, a lot of the bears for Tesla sitting in their hibernation.
Are there any bears left after the move of the last week?
What I'm saying is the bears sitting in their hibernation, in their caves, they can't find AI in the spreadsheet.
Wearing black.
They can't find AI in the spreadsheets. It's an auto company. In my opinion, it is the most undervalued AI play in the market.
One final question, because we've stress tested your position on Tesla enough. The stock has been flying. It's hard to disagree with the price action of the last week. Can you give us another pick? What do you like right now that's sort of under the radar, that's not shining brightly, that you think will?
Well, I mean, it's still massive AI Palantir. That continues to be what I view from when it comes to AI, where everything's going. I think another name to me that sticks out, even like further going, like that I'm not getting credit, is Salesforce.com. I think Salesforce.com, when it comes to the AI story, what Benioff's going to do, not even touching the base in terms of what I think this could.
We've got a minute. What is Benioff doing right now that you think's underappreciated?
I think it's the install base, and it's everything that we're seeing with our checks is that at first it was actually disrupting sales cycles. Now, I believe this is something from a monetization perspective. This could be an incremental 10, 15, 20% of revenue over the coming years. But also betting against Benioff, it's like betting against Godfather of AI Jensen, betting against Nadella and Cook. It's in that same, crowd. And look, and I think next Wednesday when the watch parties start and we have NVIDIA earnings, it just shows we are still at 10 p.m. in the AI party that goes to 4 a.m.
I'm looking forward to covering that story with you. You're going to catch up with us next week.
Great.
We're covering video. Looking forward to it, Dan. And looking forward to the F1 as well.
Next Friday, I'll be fully geared out. Ferrari. I'll be all wearing all my Ferrari gear in Vegas.
So bright red. Overalls.
Bright red.
Nice. They do a yellow as well.
And I'll do some yellow there too.
Just a sprinkle of yellow.
Look, it's all in
classic Ferrari colours.
Classic
nice,
Ferrari.
Nice. Appreciate that. Dan, thank you. Dan Ives of Wedbush, very bullish on Tesla, and that stock has been flying over the last week. Coming up in the next hour, we'll catch up with Liz Young-Thomas of SoFi, Geetha Raghunathan of Bloomberg Intelligence with Disney up in the pre-market. We'll catch up with Greg Daco of EY and Brian Weinstein of Morgan Stanley. Brian Weinstein of Morgan Stanley thinks that credit yields in America, investment grade, can trade through treasuries. Just think about that. We'll catch up with Brian in about 30 minutes' time. From New York, this is Bloomberg.
Momentum is a powerful thing. It's hard to fight against that trend.
The way that both the stock market and the bond market have acted is logical.
One thing that we can say is that the election result and what's coming out from there is just simply reinforcing a narrative that was already in play.
If you do actually get a shift back to rate hikes, it could really go against that bullish sentiment right now.
Sentiment, the news flow, it was already very, very strong. At some point, you think there's got to be a breather.
This is Bloomberg Surveillance with Jonathan Berro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, and in 30 minutes' time, you'll get some economic data. Jobless claims in America still exceptionally low, speaking to a labour market that's still okay on a headline basis. Then we get some PPI data at the same time. Then this afternoon, at 3 p.m. Eastern Time, you'll hear from the Federal Reserve Chairman Jay Powell on his economic outlook, except his economic outlook is very different to your economic outlook, because his economic outlook does not include anything on what's about to happen in this White House, helmed by Donald Trump.
It doesn't include it at all. Neither will the summary of economic projections in their next meeting in December. It's a completely different world that they are living in. And I should say, not just from the conversation, but from what the market is doing. Longer-term yields keep pushing higher. And Powell, for the most part, has been writing it off, saying it's not an issue. But this market is pricing in inflation, it's pricing in tariffs, and Powell's not thinking about it.
The market is pricing in the political economy. The Fed has yet to price in the political economy. And they're in for potentially a rude awakening when it comes to January. And the first order of business could be the tariffs, which may be inflationary according to most economists you see. Now, when tariffs were part of the agenda in the first iteration of Trump, the FOMC said this is a one-shot hit. You can look through the rest. There's not going to be this vicious cycle. If they're so high, these walls, will that remain the same?
The former Vice Chair of the Federal Reserve, Richard Clarida, was on the programme with us last week, going into the Fed decision and the news conference with Chairman Powell. And ahead of that news conference with Chairman Powell, the point that Rich made is that this Fed's probably going to start to look for some optionality, at least look to find some, to give them the choice to take a pause if they need to, going from December and beyond. And you get a real sense that started in baby steps in the news conference. And I think you've heard a little bit more of that from Fed speakers in the past few days.
I do think we have. Lori Logan talking about higher yields might be an issue for them. Neil Kashkari saying that inflation, they need to be sure it's vanquished. But it's really clear that they're not talking about it necessarily in the politics yet. They're talking about it in the abstract, that we still care about inflation. We care about this market. I want to know when they're going to more directly be saying, we're watching what tariffs are doing, and we're going to react to that. And we're going to need to react to that. Kashkari did that slightly, but we haven't had really, I think, an honest conversation about it yet.
Really small steps to getting to that destination. Here's a snapshot of the price action. Equity futures on the S&P 500 firmer by just 0.1%. In the bond market, yields just a little bit lower, down by almost a basis point, though still near 445 at 444.52. And in foreign exchange, if you missed this, if you're just waking up and tuning in, maybe you're on the West Coast, on the euro dollar 104 handle. A little bit earlier this morning, we're back to 105.33. It's another day of euro weakness. Coming up this hour, we'll catch up with Liz Young-Thomas of SoFi on whether the post-election rally still has room to run. We'll speak to Greg Daco of EY on why a December rate cut is still very much on the table. And Brian Weinstein of Morgan Stanley looking ahead to comments from Chairman Powell later on this afternoon. We begin this hour with the equity rally losing just a little bit of steam as investors look ahead to the latest economic data at 8:30 Eastern Time. Joining us now is Liz Young-Thomas of SoFi. Liz, welcome to the programme. I was mentioning at the start of the hour just then that the outlook for Chairman Powell is very different to the outlook of many people that come on this programme, precisely because he will not speculate on the future of policy changes. How much has your outlook changed since we last spoke?
Well, I would say the thing that you have to respect in the market right now is the momentum and just the optimism surrounding growth for 2025 or starting in 2025. And the idea that even though I think people recognize there are still question marks or headwinds that are possible in inflation in the form of tariffs coming through, in the form of just a slowing economy that was happening before the election and could maybe rear its ugly head again at some point in 2025. I think the general consensus right now is that any growth uptick that we might see next year will circumvent any of those headwinds. So that's the way that the market has been behaving. And what we saw right after the election, obviously a very, very strong relief rally and a cyclical rotation because of that excitement. So now we've taken a little bit of a pause, which I think is natural. Maybe we give some of it back. I mean, if you look at the charts of a lot of these asset classes that have done well since the election, the lines are just straight up to the upper right corner. So you have to, usually when you see something like that, you have to let rationality come back in for a little while before we can resume another uptrend.
Liz, we've seen a similar move in the bond market as well. I remember a note you wrote in the last few weeks, actor in a leading role, bond yields. Bond yields are still that leading role for many people at the moment. Yields were creeping higher at the long end in yesterday's session. We've had this conversation before. I just wonder how your thinking is evolving on the subject when that starts to become a constraint around equities.
Well, I think it's starting to become a constraint now because we're knocking on, or at least we're on the doorstep of the next mental threshold, which is 4.5% on the 10-year. So the first one was about 425, 430, and equities were questioning it, but didn't really have much of an issue, and stocks continued to rise through that point. Then we get to 4.5, and people start to get a little bit more trepidatious about where we're headed. I think the big question, though, that investors are trying to answer is, why is the 10-year rising? If it's rising because the economy is strong and because we have an improved outlook on the economy for the following 12 months, then that's less of a concern. And the prevailing wisdom would be that equities can withstand a tick up in the 10-year yield if it's for good reason. But there continues to be this narrative about the deficit increasing. Is it because of debt? Is it because of inflation fears? Is it because of other central banks taking action and perhaps not buying as many treasuries, buying things like gold instead? So we don't have the answer to that question yet. I think it's a good one for investors to be asking. If we get even close to 5% in the 10-year, I would expect equities to struggle between now and then for sure.
Liz, you could make a really easy argument, not saying it's right necessarily, but an easy argument that it is about growth. Cyclical stocks have been the ones that have outperformed. The rise in yields has been tracking pretty steadily the Citi Economic Surprise Index. Are we maybe overstating a bit just how much of this is about pricing in President Trump?
Well, so that's the thing that you want to pay attention to. You need the market, the equity market, to confirm basically your thesis on the yield. So if the 10-year yield is rising because of growth, as you suggest, then you would see what we have seen since the election, where cyclical sectors have led. The thing I would caution people on is that if we're trying to mess with the trade balance at all in 2025, we're in an environment right now where the dollar has been strengthening and continues to do so. If we hit an environment where the dollar is strong, we would consider that about one standard deviation away from a long-term average dollar strength level. So if we're in an environment where the dollar is really strong, you actually tend to see defensive sectors start to take over. And we're right at the precipice of that, meaning we're right at the precipice of that strong dollar environment. If we start to see a rotation into defensive sectors, that's when I think you have to sit back and question whether or not this yield move is going to start to change the way that investors have appetite for risk in the equity market.
If that happens, Liz, what becomes the haven? Because it's usually bonds. It's usually the state asset class that you can rely on. But we're starting to find some sort of floor under these yields with those fears of expanding fiscal deficits, of inflation. What do you turn to then?
Well, I think initially investors still want equities. There has not been this big rotation out of the equity market. Even in times of stress throughout this cycle, you still see investors trying to rotate within equities rather than wholesale coming out of equities. So start to look for those defensives to come back first, things like utilities. That was the usual suspect in 2024. Staples, although seemingly expensive right now, but paying a good dividend, and in that defensive category, healthcare and health insurance, I think, could see a nice bid. And then if we continue to get a lot more fear in the market, or if there's concern over yields going even further, then I think you start to see a rotation into other safe haven assets. But I think the first way would be gold. You've got a lot of appetite for gold from institutions and from central banks, but there has not been a lot of appetite for gold from the retail investor yet. So I think we could see that pick up as well.
Liz, I want to talk international and finish there with you. It was only a month or so ago we had people coming on the programme talking about dollar weakness, dollar bears, and international performing. China, let's get long China. The Hang Seng, the CSI 300, both down in today's session. They've struggled more recently. Liz, I can't find a single person right now, stateside at least, that wants to even talk about getting long Europe. How are you thinking about the international story versus the US?
Well, you know, it's interesting. I'm not going to sit here and say that I'll be the only one to do it, but you always have to question when there's nobody saying it, is that a good contrarian indicator? So what's happening right now, I think, has a lot to do with the currency market. And when we're looking at Asian currencies in particular, if you look at Japan, if you look at China, do not underestimate both of those nations' ability and willingness to support their own currency. So I don't think that there's a lot more pain that they're going to take before they start to take measures to support their own currency. So I would expect currency volatility around the globe to actually pick up over the next few months because of this dollar strength. And obviously, we're seeing a lot of weakness in the euro as a result, too. There are other issues that are going on in Europe, but I think there are some measures being taken in order to stimulate as well. But we do need that European consumer to come back. We need European luxury to come back. And some of this dollar strength is just confusing the issue for now.
Need some big changes in Europe, that's for sure. Liz, appreciate your time as always. Liz Young-Thomas there of SoFi, just finishing on the FX market. Dollar strength once again against the euro, a fifth consecutive session of euro weakness. With an update on stories elsewhere this morning, let's cross over for your Bloomberg brief to Yahara Heckes. Hey, Yahara.
Hi, John. We start with the latest on President-elect Donald Trump's cabinet. Former Congressman Matt Gaetz has been tapped as Attorney General designate, while former Congresswoman and former Democrat Tulsi Gabbard is the pick for Director of National Intelligence. And Trump confirmed that Senator Marco Rubio is his pick for Secretary of State. But yet to be announced is who he wants to run the Treasury Department. The Wall Street Journal reporting Cantor Fitzgerald CEO and transition co-chair Howard Lutnick is making a late play for the role. Meanwhile, the vice president of Nippon Steel is heading to Pittsburgh next week to meet with U.S. steel union workers. The move signals that the Japanese company is making a push to persuade rank-and-file employees its $14 billion takeover bid will be good for their long-term prospects. The news comes as both companies await a decision about the pending deal from the U.S. Committee on Foreign Investment. During his campaign, President-elect Donald Trump did say he would block the deal. And U.S. officials say Chinese hackers breached multiple telecommunications companies in a broad espionage campaign. They reportedly targeted the phones of President-elect Donald Trump and J.D. Vance, among others in politics. China's foreign ministry spokesperson said the nation opposes disinformation due to political agendas. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the programme, The Morning Calls Plus, we'll speak to Geetha Raghunathan of Bloomberg Intelligence as Disney gets a box office boost. That stock is up in the pre-market by more than 8%. In about 15 minutes' time, some economic data, PPI and jobless claims. Look out for that going into it. Equity futures positive by 0.1% on the S&P. The bond market, some stability for you, just short of 445. Yields at 444.72 on a US 10-year. Let's get you some morning calls. First up, HSBC hiking Nvidia's price target to 200, seeing more upside in data center momentum. That stock is up by another 1% in the pre-market. Next up, Barclays upgrading American Airlines to equal weight, saying the carrier will regain market share in corporate travel next year. That stock is up by 1.6%. Execution this year has been a real problem over there. And finally, Evercore adding Target to a tactical underperform list, expecting further sales trend deceleration. That stock just a little bit softer. We're negative by 0.4%. Let's turn to Disney, the company beating expectations thanks to a streaming boost and this year's box office performance, underscoring the turnaround set in motion by the CEO, Bob Iger. Joining us now is Geetha Raghunathan of Bloomberg Intelligence. Geetha, that stock is up nicely in early trading. It's rare to provide not just a one-year outlook, but a 2- and a 3-year outlook as well for profits. Where's that clarity on the future coming from?
Oh, investors are loving it, John. I mean, this was the biggest thing that, this is exactly what the doctor ordered, right? The biggest problem with Disney was the lack of clarity on how things were going to pan out, in fiscal 2025 and obviously in the future. And with them kind of giving us that detailed line by line item kind of guidance, they've really set the tone and, giving us a lot of visibility into high single digit earnings growth. So good momentum sustaining into fiscal 2025. And then as you get into fiscal 2026 and 2027, they're projecting double-digit EPS growth. So really a lot to look forward to for Disney investors.
A lot of the success of this quarter, Geetha, came from their box office, from Inside Out 2, from Deadpool and Wolverine. It wasn't that long ago that Disney was rethinking the spend that it would be doing on content. Given that it was movies, something that during the COVID era really lagged behind and was impossible to go to, was kind of the stick, the thorn in the side of Disney. What does it mean about how willing they're going to be able to spend on content going forward?
Yeah, you're absolutely right, Danny. I mean, they had huge problems, of course, with COVID, with the pandemic kind of shutting down theaters completely, and them kind of really almost over-investing a little bit in their streaming business. So, in fact, when Bob Iger came back, he said the problem was not just content and a little bit of subpar content. It was just that there was too much of content, and it was almost kind of oversaturating and leading to this franchise fatigue or exhaustion amongst investors. And so that's something that, there's been obviously a course correction on that front. They're really now focusing on paring back on content, on taking the focus back to quality rather than quantity. And you see that in their multi-year kind of strategy that they've laid out for all their biggest franchises, whether it's Marvel or Star Wars or Avatar. They have really a very good strategic plan in place. And we're going to see that kind of, it's not just Inside Out and Deadpool, just in the next month or so, you have really two very, very highly anticipated movies kind of setting the tone for fiscal 2025 with Moana 2 and, Mufasa, which is the big Lion King live action movie.
Well, and John started with this. I mean, they have a clear plan and a clear outlook and a clear guidance up through 2027, which, by the way, Geeta, at that point, we should have a new CEO or at least a new one announced by Iger. Just given that strength that they're coming from and the plan that they've laid out, does that change the type of person we might see?
So that's a great point that you bring up. So Disney has always historically kind of looked inwards. They've always had this deep bench, this pool of candidates that they've drawn from. But just a few days ago, we actually got some news suggesting that they've actually started looking outwards. In fact, Andrew Wilson, who is the CEO of Electronic Arts, a big gaming company, has also kind of been thrown into the mix. So it's going to be interesting to see, who exactly. Obviously, they do have all of their, division heads who are also in the running, the ESPN head, the Parks head with Josh D'Amaro, Dana Walden. So it's going to be interesting, but you're absolutely right that their choosing of the new successor will definitely kind of tell us which path this company is going to go forward on. Is it going to be more operations and a parks-driven focus, or is it really going to be content, which is really an IP, which is kind of really the driving force and the engine for all of these companies' different segments?
Geeta, do you have a timeline for how long this is going to take?
So the successor, they had initially said, Anne-Marie, that it would be in 2025, but they've actually pushed that out. You have James Gorman, who's now leading the process. They've pushed it out to 2026. So by 2026, we should have, the name of the new CEO. And by the end of 2026, Bob Iger is set to finally kind of lead the company.
Well, we've been there before. We've seen that story before. What have they learned from that episode?
Oh, too many things, right? This has been the biggest misstep for Disney. And so obviously they want to get it right, which is why they kind of have James Gorman leading this process, which is why they've kind of expanded the search now to include really everybody. And just having kind of Gorman there, I think, inspires a lot of confidence. He has orchestrated a fantastic succession at Morgan Stanley. He is set to be the right person for the job. And, he's also the chairman of the board. So I think there's a lot of confidence that they will get it right finally.
Hang on, Geeta. Why isn't the lesson that they learned that they should just be looking internally? Isn't that the lesson of Iger coming back, that maybe widening the tent to external people doesn't make sense and maybe misses the culture and the direction of Disney?
Yeah, it's really hard, Danny. I mean, Disney is such a diverse company, and they've tried internal candidates. So Bob Chapek was an internal guy who was running parks, an absolute veteran who couldn't really manage all of the pulls and pushes at the content division, right? He didn't know a lot of how to handle things with the creatives, with all of, how to hobnob with all of the Hollywood talent. And that's kind of what got Disney into a little bit of a mess. I mean, before that, of course, we had the whole Tom Staggs and the Jay Rizzullo situation. Again, two very successfully groomed internal candidates. They went through the whole process, but again, suddenly at the last minute, it didn't kind of pan out. So it's going to be interesting. Of course, the internal candidates have a lot of experience, but again, just with the divisions, right? You have parks on the one end, and then you have a completely different animal when it comes to content and the studios and the ESPN business. So they are obviously very big shoes to fill. So again, it's going to be a little bit of a wait and watch.
Let's talk about the parks, Geeta, because in the quarter that they reported, there was some weakness weakness, but they're projecting 6 to 8% operating income growth in the quarters to come, in the year to come, rather. What's going to be driving that? What sort of environment with consumers and willingness to go out to parks, to go on their cruise ships are we going to be seeing?
Yeah, so fiscal 2025, Danny, is a really interesting year for Disney because you have a big competitor kind of coming out with Epic Universe, which is the new Universal Park that's coming out in Orlando. But for Disney itself, yes, they have seen a moderation in demand across their parks. But at the same time, they are launching cruise ships. So what is really driving that big, high single-digit increase in profits in fiscal 2025 is going to be the launch of these 3 new cruise ships, which, of course, in the beginning of the year is going to kind of weigh on profits because of launch costs. But once they get up and running, those are going to be the big profit drivers.
When it comes to the profit driving on the content side, we're seeing this growth in streaming, and that's offsetting the decline in these cord cutters. Last month, Comcast was talking about spinning off its cable networks. Any change in portfolio you see going forward for Disney?
I think they were asked this question just a few minutes ago, the CFO, and he said he likes his linear TV portfolio as is. That said, Anne-Marie, they do have a very big event coming up in fiscal 2025 with the launch of a streaming standalone ESPN product. Now, this kind of really puts everything in play, right? It puts their TV networks in play. One of the reasons that they might have been reluctant to kind of offload the TV networks was because, of this ESPN. ESPN is kind of the glue that holds the whole TV bundle together. But once that goes over the top, I think it's a fair question. I mean, why not, spin off their TV networks? They really have nothing really holding them back, in my view. But so far, they seem to want to hold on to it, I think, at least until the ESPN launch goes off successfully.
Geetha, how much more money do they think they can charge us for Hulu? It's driving me nuts. Every few months I get the email.
Lots more. So, I'm saying that because you just look at their profit projections, John, in the streaming division. I mean, not only have they turned around, that division after $4 billion losses 2 years ago, $2.5 billion 1 year ago. This year, of course, you have a modest amount of profit. Next year, they're projecting $1 billion. And then what's really interesting for fiscal 2026, John, is they're projecting almost, I would say, almost a tripling of that profit from $1 billion to $3 billion. So all of that is going to be driven, at least in my view, by pretty big price increases.
I'll pay up if they release a new season of Shogun in the next 6 months. All right, Geetha, appreciate it. Geetha Raghunathan there of Bloomberg Intelligence. I forget what I'm paying now, but it's ridiculous. You throw in the cost of broadband, and basically we're back to the bundle plus $50.
I want to know if that sports venture is going to come out. Remember that thing that a judge blocked with ESPN and Fox? I wonder if this is going to be a better environment for them. I think people would be willing to pay up for that because there's just so many different things you need to buy at the moment.
I have a solution for Jonathan. Go back to school. $1.99 a month, if eligible, if you're a student.
Is that what they do? So I should sign up for a course?
Yeah, sign up for a course.
Free course.
With ads. It's $1.99 a month. You can't beat that.
What should I study? That's the question.
It's up to you.
We'll figure this out. We'll
Commercial
work this
break.
out, yeah? Disney, up by about 9% in the pre-market. Up next on the programme, we'll turn to the economic data. PPI just around the corner, together with jobless claims. We'll get the view of Greg Daco of EY, and then we'll get the market response, the market reaction. We'll catch up with Brian Weinstein of Morgan Stanley. From New York City, just a brief check of the markets for you. Equity futures on the S&P 500, up by around about 0.1%. No drama there. In the bond market, we're down a single basis point or two, 443.54. And in the FX market, more euro weakness. New lows for the year on euro dollar earlier on in the session, a 104 handle. At the moment, 105.38. This is a fifth consecutive day of euro weakness, and we're still trying to find a euro bull. If you're out there, reach out, write it on a postcard. We'll do an interview, a long conversation about why you like Europe right now. From New York City, this is Bloomberg. Anne-Marie wants me to study the Beyonce course at Yale University for 60-something thousand a year. 60-something thousand a year, and your kid goes to study Beyonce at Yale University?
It's apparently going to be a single credit course, which then means you'll probably get the student discount on Hulu.
That's absolutely ridiculous. I'd rather just pay up for Hulu. Make more sense. Some economic data just seconds away. PPI and jobless claims in just a moment. With that economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Well, we've got a little bit of a surprise in PPI core, up 0.3, a little stronger than anticipated. The headline is up 0.2 on a year-over-year basis. Headline 2.4%, 3.1% for the core. That is higher than anticipated. John's favorite number in the whole world, initial jobless claims, 217,000. That is down from the prior month, and it looks like we are still in the throes of a strong labor market, which sets us up for an interesting retail sales report tomorrow because people still have money. According to the latest revisions, we still have more money than we thought we had. So overall, you still have the question about what does the Fed do in December?
I like the number, Mike, because it just is what it is. And it's just really low at 217. And for the Federal Reserve, who are worried about the labour market break-in, we had that gap out in jobless claims. I remember last summer, freak out, came back in. Gapped out more recently, freak out, comes back in. This is setting up potentially for a pause, maybe not in December, but perhaps going into 25. Is that how you see things?
It could be, because December, obviously we are adding a lot of part-time workers at the retailers and things like that, so you'll have fewer claims. But what it does show is that the hurricanes have washed out of the data, so the November numbers should be relatively strong if we get a rebound from what we saw in December. And that'll also raise questions about what the Fed does. And so at this point, it looks like the labor market hasn't moved at all, stays about where Jay Powell and the Fed thought it was. It's the inflation numbers that we're watching now. And basically what we see here is sort of a confirmation of CPI, that we have stalled out at a certain level. Do we continue to stall out? How much of it is seasonal? Final demand goods, we're only up 0.1%. That's down from last month. Services up 0.3% in the PPI. So at this point, where do we go from here? That's the Fed's dilemma. And then you throw on top of that the policy questions.
I know you need to look through some more of the details of PPI, Mike, but when I look at PPI, and I know we care in so much that it feeds into PCE, which is, of course, the Fed's favorite measure, I look at a number like 2.4% year over year. Could I not just say that's all asset managers? Stocks have gone up. They've been pumping out money. They've been pumping out and adding to that, and that's behind it.
We do want to look that up. And the thing about PPI, and the day that PPI comes out, the economists around the country who are extreme nerds get out their Excel spreadsheets, plug in the data like that number into their PCE forecasts. And I was reading this morning a PCE forecast that said it's going to be stronger than people expected because of asset management. There's been so much trading that it just pushes up the cost, and that is going to be something, that's the old pogo trade. We have met the enemy and he is us.
Off the back of this in the bond market, yields inflecting just a little bit higher, up a single basis point. PPI just a bit hotter than expected. Jobless claims a bit lower than expected. To weigh in on all of this, I'm pleased to say that joining us now is Greg Daco of EY. Greg, welcome to the programme. This is what I heard from Ian Lincoln of BMO before these numbers dropped. He said Santa pause has left the building. They're going to cut interest rates in December. Do you think that pause has left the building, Greg? And is there enough here and in the next 4 weeks or so to disrupt this easing bias at the Federal Reserve?
I think generally speaking, the Fed is still on board with this gradual easing cycle. You still have, if you look underneath the surface, fundamentals that are pointing towards disinflationary pressures into early 2025. You've heard me say this in the past, where I look at consumer prudence in terms of facing these higher prices, reduced markups and reduced pricing power, easing wage growth, strong productivity. Those are all fundamentally disinflationary and will continue to push inflation underneath the surface towards 2%. Whether there is bumpiness in the near term, that's going to be a guaranteed element of the outlook. But I think the Fed really wants to recalibrate a little bit closer to neutral. And as to your question to Mike earlier about does it start to ease more slowly in 2025, I think yes. The upside risks to inflation in 2025 and 2026, and the fact that they're going to be looking for that neutral rate will likely make them go a little bit more slowly in 2025 in terms of easing.
Greg, do you think that neutral rate is closer to 4 than it is to 3?
Well, I think we don't really know, and the Fed doesn't really know, and Powell has expressed that. He will only know that once we're there. But I think with regards to traveling towards that destination, if you assume that by the end of the year we have a Fed funds rate around 4.4%, that tells you that they're going to be more cautious to navigate these easing cycle with a little bit more prudence, not necessarily going 25 basis points at every meeting, but perhaps skipping one meeting, pausing, waiting for the data to confirm the direction of travel, and also waiting to see any potential policy developments. Because we know some of the policies that have been pushed by the incoming administration risk being inflationary, whether it's immigration restrictions, deregulation that could favor a bit of stronger growth, or even later on, tax cuts and tariffs could all be inflationary over the course of the next couple of years.
And the market, the bond market, Greg, has started to price both that in and just the good data we've seen. Is it not a problem for the Fed? As you say, they want to start normalizing. Inflation's coming in. But as they're attempting to normalize, that financial conditions are getting tighter.
That's right. That's one thing that they have to pay close attention to. And Powell didn't want to wade too much into that, into whether this was driven by the term premium. The rise in yields was driven by the term premium, by expectations of stronger growth, expectations of higher inflation, expectation of larger deficits. There are a number of factors that could play a role here. But the short end is really that if there is persistence in this tightening of financial conditions, all else equal, that would favor the Fed easing a little bit more because it does not necessarily want to have a more restrictive set of financial conditions. And that is really the way they're going to approach this. If there is persistence in this tightening of financial conditions, then they might lead towards more easing in terms of monetary policy. We're not there yet. I think we have to see how things evolve over the next couple of months with more clarity on the upcoming set of policies that will be developed in 2025 and 2026.
Greg, do you think it's right what we've heard from the Fed and what we're likely to get in the summary of economic projections, that they just don't include any assumptions whatsoever? In the words of Powell, I don't assume. Is that the right kind of language you want to see coming from the FOMC?
Well, that's absolutely right in the context of the uncertainty with regards to policies. But I would have liked, and we've talked about this in the past, I would have liked to see more of a forward-looking perspective in terms of economic dynamics. Just like I was talking about fundamentals being disinflationary, I'd very much like to hear the Fed and Fed policymakers talk about how they're looking at inflation dynamics rather than just comment on every single report that we get and comment on past data. I would have liked to see much more of that forward-looking perspective because that's important when you're guiding monetary policy. What are your perceptions around the future of inflation dynamics? Where do you see neutral? You don't have to be pinpoint estimating where it is exactly, but where do you think it might be? And how are you going to get there? That forward-looking perspective has really been lacking in this data-dependent world.
Hopefully we get some of that from Chairman Powell a little bit later on this afternoon. Greg, it's great to get your thoughts, as always. Greg Daco there of EY. If you are just joining us, welcome to the programme. Some economic data moments ago. PPI coming in hotter than expected. Looking at initial jobless claims coming in lower than expected. 217 against an estimate of 220. That's the right kind of downside surprise. Off the back of this, in the bond market, you'll see yields just starting to creep higher at the front end of the curve. On a 2-year now, up by 2 basis points, and at the long end, getting closer and closer to 450, a level that we have rejected a few times over the past week. 447.88, yields up on a session by 2 basis points. Mike, you had another look at the data. What jumps out?
Well, we're going to do a surveillance apology to all of the traders out there, because the question Danny asked me, a securities brokerage dealing and investment advice down 2.3% for the second month in a row, a significant drop. So it is not Wall Street's fault. But we do see health insurance up 0.2, property and casualty insurance up 0.1, and then airfares, airline passenger services, 3.2%. So those will go into PCE and things won't look all that great. And the one other thing I got to point out to you guys, because you were just talking about cable TV services when I walked in here, cable TV services and bundled services up 6.5%. That's one of the biggest increases in the entire PPI. So, yes, you can
Not
complain.
a shocker. A real-world experience. Mike McKee, thank you. Brian Weinstein and Morgan Stanley with us around the table. Brian, welcome to the programme. If we get a cut in December, is that the last one?
It's the last one for a while. It could be the last one. I think they take the first quarter off, at least the first 2 meetings. There's a lot of things that they have to sort through. I think this 100 we had got here was automatic, right? We can all talk about the data and every data point reacting to it, but we didn't. We didn't react to it. The data was stronger, and we used 100 basis points, right? The reaction was 550 was probably too high. 450 sounds more normal. Is it? We'll find out. So I think that's where we are, but I think it's time to watch and let the policy take effect and see what happens.
What concerns you? Is it the current level of things? Are you looking less of the trend and more about the levels and getting concerned that maybe we get stuck around these kind of levels?
I think we get stuck for a little bit. And listen, our investors, speaking with their wallets, are buying fixed income, right? We see it everywhere. The money's coming in. You're getting a decent coupon. It should be a hedge for equities. It hasn't been a great. Although now at the back of the highs in yield, the correlation's breaking down a bit, right? Equities are doing okay. So my instinct tells me the trade for next year is that we're going to seek out the higher end of this range. So call it 4% to 5.5% maybe for next year. I don't think we get there quickly. If we do, it's a problem. It'll hurt risk. But if we get there, kind of hang out at 4.5, start to move higher, I think the market will be okay as long as it's a growth story. You have all the debt stories, you have inflation, but I think at the end of the day, the growth story is actually the important one.
And in the meantime, Brian, can you touch duration at all? There are just so many unknowns for 2025, and it's playing out on the long end of the curve.
Yeah, listen, when I look at the yield curve, I say history is a great guide, right? 2s, 10s in a normal cycle should get to 150, 200 basis points. 10s bonds, let's forget the deficit for a second, just normal times, should get 80 to 100 basis points. I look at the yield curve and go, wow, if 2s are going to be stuck at 4.5, and you make a big gulp, right? If you add 200, you get some big numbers there, right? If that's where we're going. So yeah, I think duration has a place in a portfolio. It always does. And I could be wrong. Yields could fall 100 basis points. So I don't hate it as yields go up. But again, I don't see a reason to rush into it if you believe we're going to go back to normal looking yield curves and you don't think Fed funds is going to go back to 3, right? So there's a lot of variables around it. That's how I look at it.
But that's still not kind of the most comforting for, as you say, something that's usually the haven, usually something that's uncorrelated with equity. So what becomes that in the portfolio?
Well, listen, I think on the front end of the yield curve, you still get you can get good income without the duration. We've seen big flows into floating rate loans, short duration municipals, income funds in fixed income that have less duration and more coupon. So I think you can get coupon without taking max duration risk, is how I would look at it. And again, that's what investors have been buying.
I was saying you were coming on the program about an hour ago, and I teed up the credit conversation, so let's do it. The spread right now for investment-grade credit is like this big, 76 basis points. It's as tight as it ever has been for the whole of this century. I want to understand from you why you think it can get a whole lot tighter from here.
I think it gets tighter from here. I think there are 2 major reasons. One is the buying dynamic, right? So listen, if I'm right and yields drift higher, there's a lot of government debt. We've covered that. There's less corporate debt relative. So people will continue to buy corporate debt. If the growth story is good, equities do fine. And so credit gets tighter. The second piece I think people don't truly focus on, which is the market structure has changed in the 100 years. How hard was it to trade corporate bonds when I started in this business in the early 2000s? Now you have ETFs, right? You have baskets of bonds trading. Credit is much, much more liquid. So if there's less default risk currently, too much government debt, and it's easy to buy, I would say, again, I would think there's a mathematical limit somewhere around 50 basis points, a little bit less, maybe. That's a pretty aggressive call. So I don't think we have to get there. But I do think in an orderly sell-off, credit will continue to frustrate people and continue to tighten.
Yeah, but your call is so much more aggressive than that, and you're burying the lead. There's the spread. You think this can happen? That Treasury yields could go above what we could see in corporate America, maybe not across the whole index, but perhaps possibly on a few credits.
Well, there's so few high-rated credits, right? The other century change is that the BBB part of the index is so much larger. So I don't think you have BBBs trading through government bonds. But for those few companies that can trade with an A, I do think there'll be a select few, some of them are really close right now, to go through government bonds. Do I think it's logical? No, the government can print currency, right? It's a better credit. But I think it's a supply-demand dynamic. And listen, you can make an argument that if you have fiscal irresponsibility, that maybe I'm wrong. Maybe they should trade through. So I think they will in certain credits, and I do think credit tights are not. We have not seen them yet.
Well, corporate credit is one of those markets that people look to get a signal for overall health. That okay, if spreads start to blow out, then I need to get worried. You mentioned the ETFs, but I also just wonder how much of this is just a really distorted risk premium. Not even with ETFs, but all the risky stuff is starting to go to private credit now. Can we really use corporate credit as a signal anymore, as in the way it once was?
It's a fair question. Listen, you're right. A lot of the risk has moved to private balance sheets, doesn't get marked to market. Does that leave higher quality or lower quality stuff for the public markets? We can debate. I think the investment grade credit market is a little less affected by it. So I do think it's a kind of a chicken and egg question, right? If the equity market goes down 20%, is credit going to be wider? Of course. Will it be caused by the credit market? I don't know this time around. Again, I think investors are happy to buy the extra spread and the yield you get from treasuries plus corporates. And I think there's some logic to be said. I don't need to own treasuries. There's not a lot of upside to doing so. Your duration question earlier. So again, we're tight. Credit spreads are tight. I think they'll get tighter. Listen, if it gets disorderly, if 10-year notes are 5.5% in 6 weeks, it'll be a different story. But if it moves in an orderly fashion, I think that's where we're going.
Brian, we're going to hear from Jay Powell today, and you started the conversation saying that December might be the last cut, and maybe no cuts next year. Could we see hikes next year?
Listen, it's fun to talk about. I don't have I don't think I could sit here and lay out for you exactly how we get there. In other words, if inflation runs 0.2 to 0.3 instead of going back to 2, is the Fed going to go right back to hiking? I don't think so. So I think it's possible. I think it's more likely that they just want to sit here and let the government do the work. That they can say, listen, maybe we'll say 4.5% looks more like neutral than we thought, right? Could it be 4? Sure. I still don't think it's 5. So hikes would require all of these things to happen, tariffs be super inflationary, but still pro-growth, and equities making new highs again. It would be. I could tell you this story, but I don't sit here thinking about rate. I don't want to bet on a rate hike in September as my base case.
You don't want that to be the headline, Brian. No. Don't worry, it won't be. It'll be something else on credit. Brian Weinstein there of Morgan Stanley. Brian, appreciate the update, sir. Thank you. Speaking of 4.5%, very close to that level at the moment on a 10-year as we speak. We're up by 2 basis points, the 10-year 4.48. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Meta has been hit with an $841 million fine from European Union regulators. It's a small fine for the tech giant, but its first ever penalty for EU antitrust violations. The European Commission has ordered Meta to stop tying its Facebook marketplace service to its sprawling social network. Meta was also ordered to refrain from imposing unfair trading conditions on rival secondhand goods platforms. The company has vowed to appeal the decision in court, a process that could take several years. Meanwhile, Capri shares are lower and Tapestry shares are rising more than 8% in the pre-market after the fashion companies agreed to call off their $8.5 billion merger. They're saying it was in their best interest since they were unlikely to get regulatory approval before the deal was set to expire in February. Tapestry, the owner of Coach and Kate Spade, had wanted to join forces with Capri, whose biggest brand is Michael Kors. But a court blocked the deal after the FTC opposed the merger on grounds that it would harm competition in the market for affordable luxury handbags. And ASML shares are higher in Amsterdam trading after announcing it's maintaining its bullish long-term outlook. The chip maker projects sales in 2030 to range anywhere from $46 billion to up to $63 billion. That's according to a statement issued as part of its Investor Day taking place today. The announcement is a relief for investors after ASML's order intake took a hit in the third quarter, falling well short of analyst estimates and triggering a big sell-off in the stock last month. That's your Bloomberg Brief. John?
Hey, Hara, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead, looking ahead to Chairman Powell at about 3 p.m. Eastern Time, and we'll catch up with a familiar face. The latest from Berro after the commercial break. Equity futures right now just about unchanged on the S&P 500. Some developments in the bond market, though. PPI came in just a touch hotter than expected. Jobless claims came in just a bit lower than expected, and that unlocked higher yields again just for a moment by a basis point or two on a 10-year. We're back to about 4.47. As we count you down to the opening bell, here's the trading diary. The week ahead, the calendar shaping up as follows. Today, we get Fed speak from Powell, Barkin and Williams. Tomorrow, some retail sales data. A sneak peek of earnings next week. Tuesday, Walmart. Wednesday, the big one, Nvidia reports. A quick programming note for later today as well. Lisa sitting down with the JPMorgan Chase chairman and CEO, Jamie Dimon, at the APEC CEO Summit. I'm pleased to say that Berro joins us now for more. Lisa, good morning to you. What's coming up a little bit later?
Buenos dias, Jonathan Ferro. I will tell you that it is so interesting to be here at this moment with APEC, given the fact that right now you have the Chinese influence very dominant in a country with a long history with China. I am going to be speaking with Jamie Dimon later today. Key question, obviously, is what do you think of the election? What has the response been from the companies that you speak to? But beyond that, there is a real vacuum here of power. We've got Joe Biden coming here today, but he is a lame duck president at a time where there's a real question mark, John, about just us what the trade relationship will be between the U.S. and other countries at a time where China clearly is being aggressive, trying to make inroads with a whole host of nations, particularly if they have precious minerals like what we see right now in Peru.
And Xi Jinping and Joe Biden will be sitting down with each other on Saturday, Lisa. I'm sure that agenda list is very long. But to your point, with Biden showing up as a lame duck, how much inroads is China making on the global stage?
This, to me, is honestly the most interesting aspect of these meetings, because what I'm hearing from trade ministers from all around the world, particularly in Asia, is they are seeing direct investment from China, particularly when it comes to technologies, particularly when it comes to, say, copper here. They're opening a new port. They're christening a port. Xi Jinping is here to celebrate the opening after 10 years of work. And this port is going to shorten the time for goods to be transported from Peru to China, to Asia, by some 10 to 15 days. It really shows how China is trying to lock up some of those economic ties at a time where it's really unclear what the U.S. relationship is going to be. And really what I hear from trade ministers all over the world is this question to U.S. companies. Are you going to be investing more here? How are you going to be investing? And are you committed at a time where policy is a bit more ambiguous?
Lisa, I'm really looking forward to your conversation with Jamie Dimon, especially because you sat down with him a month ago. I wonder what some of the changes we might see in Dimon, especially, I remember him telling you that the U.S. is becoming anti-M&A. Are you going to get a much more bullish Jamie Dimon this time, you think?
That's a great question. We are going to address that. How much are the gates, the floodgates open? We did hear about that from the Citigroup CEO, that basically it's game on in the M&A market. I'm very curious to see how big the pipeline is, how much companies are saying, let's expedite this, let's get it all ready so that we can really get hit the ground running early next year. But this is a real question. How much does this revive some of the animal spirits that we see from companies that have been waiting for some certainty before investing? And frankly, he is in the position to really have a sense of that. And right now is the moment. I do get the sense from people here that there is really a clear sense of start making investments now. Certainly you're hearing that from China, and I'm sure from U.S. companies, they feel that as well.
Gracias, Bramo. Mucha suerte. Thank you. I think that's right. Or is it buena suerte? What is it for good luck?
Muchas gracias.
Thank you.
Buena.
Thank you.
Perfecto.
Buena suerte?
Yeah.
Thank you.
You got it the second time around.
Okay, we got there eventually. Coming up next, tomorrow morning, Andrew Sheets in English of Morgan Stanley, Matt McGuinness of the Committee for a Responsible Federal Budget. Looking forward to that. Phil Camporelli of JPMorgan, and we'll speak to Steve Rasciuto of Mizuho. Do not miss that conversation with Jamie Dimon a little bit later. If you do, we'll play some of that for you tomorrow morning, and we'll catch up with Lisa later on in the programme. From New York City this morning, good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special NITO ATP Finals update for Bloomberg TV and Radio from Tennis Channel. I'm Andrew Guy. Carlos Alcaraz put his first win on the board as he took out Andrei Rublev to keep his hopes of reaching the semis alive. The reigning Roland Garros and Wimbledon champ lost his opener to Casper Ruud, but held his nerve in the second set breaker to close out the Russian. Alcaraz will make the Final Four if he wins his last group match against Alexander Zverev on Friday.